Good morning, everyone. I'm Brad Smith alongside Jared Blickery. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, OPEC's surprise decision has sent shockwaves through the oil markets. The Saudi-led group of oil producers have unveiled a round of output cuts of more than 1 million barrels per day from May until the end of this year. On the news, Brent Crude saw its biggest intraday increase in more than a year, and top oil analysts, they've made calls for $100 crude oil since the decision. The second thing that you need to know, Tesla sets a new company delivery record. The EV maker posted its first quarter delivery and production numbers, beating estimates and proving that its price cuts are helping boost demand. Tesla delivered over 422,000 vehicles across the globe in the quarter, up from 36% from a year ago. The company easily beat on its production numbers, and the global sales of its Model 3 and Model Y SUV is surged. CEO Elon Musk said last quarter that he expects Tesla to deliver nearly 2 million vehicles for the year. And a buyer has entered the squared circle. WrestleMedia company WWE has finally reached an agreement to be acquired by Endeavor, which runs Ultimate Fighting Championship, also known as UFC. Endeavor will combine WWE and UFC into one publicly traded company, forming a $21 billion global sports entertainment business. The deal marks the end of a 70-year era for executive chairman and owner Vince McMahon, who will remain the chairman of the new company behind Endeavor CEO Ari Emanuel. Well, back to oil prices. Oil prices surging after OPEC Plus producers made an unexpected decision to cut oil output by more than 1 billion barrels per day, or 1 million barrels per day, on top of the 500,000 daily barrels that Russia announced it's cutting last month. Joining us now to discuss everything oil and the energy world is the Energy Word founder, Dan Dicker. Dan, great to have you here with us today. So first and foremost, this was a surprise decision by OPEC Plus here. What was some of the reasoning that they put forward behind it?
Brad, this is part of what has been a very slow-burning Cold War between basically Saudi Arabia or OPEC Plus, really the same thing, Saudi Arabia and OPEC Plus, and the United States, Joe Biden and the Federal Reserve, who have been targeting oil prices basically since the summer of 2022. And there was, the response to this by OPEC Plus is with the only weapon at their disposal, and that's production cuts. They put together a 2 million barrel a day production cut last year in November. And although this came as a surprise in terms of the timing, even in November, I came on your show and I said that it wouldn't be unusual if that wasn't the last salvo that the Saudis kind of launched at this, this war between trying to support oil prices that really don't have a fundamental, imbalance going on in terms of demand, but yet prices have been forced down by work by releases from the strategic reserve and also from, kind of endless cuts from the Federal Reserve.
Dan, I remember your call from last November. Is it possible there will be another salvo? I'm looking at some of these production cuts, and especially this latest one, as potentially very well timed, at least in terms of technicals. Oil had just broken down below the $80 per barrel level, and then it shot back up above. And then you take into consideration the commitment of traders reports, how large traders were, positioned coming into this announcement. It looks like the market was due for a short squeeze. Could we see another opportunistic, timing announcement like this in the future?
Jared, I think you have this 100% right. I couldn't have said any of this better myself. There's been a general kind of fear from traders of getting long oil. And so there's been just a natural kind of, lack of length in the oil market, which makes, the oil market, ready for this kind of huge pop based on an announcement like this. Now, I don't think the Saudis, play that big a game in terms of, the speculative interest in oil markets like we do, or I do for sure. And their only thought right now is that, there is an economic kind of question in front of them. And it's really simple. What should we do in order to retain the profitability of the barrels that we're pumping And how can we keep prices at a level that'll do that? And so if you have, it's really simple. If you're pumping 11 million barrels at $70 a barrel, that's $700 million a day that you're getting. And if you can cut your production by 1 million barrels a day, but get oil prices up to 80, then you've got 10 million barrels a day at $80, which is $800 million a day. So basically, it's a little bit more money, and you're working less hard, and you're making the same profitability or even more. So, in every way, this is sort of an economic question for a country that relies 100% on oil revenues in order to survive. So in the end, that's the only calculation that OPEC will make going forward. Will they have another cut? Yes. If prices go low enough, they'll be forced to have another cut like this. And if they go high enough, they will start to lessen these kinds of production cuts. But it's going to be that kind of war between what the Biden administration, the Federal Reserve, can do with monetary policy and also with a strategic reserve, opposed to what OPEC Plus can do with flat out supply.
We're talking about a time of the year, Dan, too, where people are, being more mobile. They're getting out. They're traveling more as well. We were just taking a look at the gasoline futures. They shot up by about 3%, as well as the share prices for all of the major kind of oil and gas companies here in the U.S. Did the summer travel season just get that much more expensive for any passenger or traveler as well, given this decision?
Yeah, we've already had a very kind of deep capacity in the refining sector anyway. So you've seen gas prices stay sticky at around $3.50 a gallon, despite the fact that oil had gone under 70, at least briefly. So there's a refining capacity problem in the United States. And yes, of course, whenever you increase the price of the base product, crude oil, that goes into making gasoline, it's going to get worse. But again, there is a refining issue that needs to be solved on top of the issue of supply, which right now is ample here in the United States. But again, it's the shortfall on capacity that may be a problem going forward, depending on what kind of driving season we get in the summer.
And Dan, anytime we have a move in this direction by OPEC Plus supporting oil prices or increasing them, a lot of times there is pushback by the U.S., either by the administration, other groups. I'm just wondering in terms of what there might be in terms of any pushback here that you see on the horizon. Also, the SPR, the Strategic Petroleum Reserve, there had been calls for filling that with oil prices that had been reduced. They're still at lower levels within the last couple of years range, but off of their lows here. Just wondering how you view the U.S. response to this.
Yeah, it's a very interesting question. I don't know how much more that the Biden administration can do. The Strategic Reserve, if you're going to maintain the mandate of that Strategic Reserve, needs to get some fillback happening at these lower levels. And Granholm has already said that they're not really interested in refilling the SPR. Now, personally, I don't find that to be a bad decision. I think the SPR has long outlived its usefulness, and the United States should get out of the business of buying and selling oil when it suits them. But that being said, I don't know what else can be done. I don't think there's a ton of barrels left to be released from the SPR, although I don't put it past the Biden administration to empty the SPR further. Again, this is a Cold War that's going to go on for a little while, and the Biden administration is has been very successful in keeping energy prices low, despite the fact that demand has basically stayed pretty much the same. So I think they'll do more of the same. I think this puts a little more speed or a little more heat into the Fed cutting again in May, and maybe even another cut after that. These are the prime weapons that the United States has in keeping oil prices low. And I think that the United States and Joe Biden are going to use them.
A very good point there. Just a reminder that elevated energy prices, another recession factor there. Really appreciate your insights. As always, Dan Dicker, the Energy Word founder. Tesla revealed Sunday deliveries shot up in the first quarter, representing a 36% increase from the year prior. And this comes after Tesla slashed prices across the globe just a few months ago, sparking a price war in EVs. And joining us now with the latest is Yahoo Finance's Praz Supermanian. Praz, the details, the numbers, please.
Yeah, Jared. So this is an all-time record for Tesla delivery-wise, 423,000 for the quarter, barely beating Bloomberg estimates of 421,000. Although they handily beat estimates from the production side, they produced 441,000 cars, estimates of 432. So strong numbers there. The price cuts are clearly working. The demand is being boosted there. But I think there's a little bit of concern here about the future, right? And Tesla said they want to hit about 1.8 million vehicles delivered this year. Right now they're trending at about 1.6. Can they boost that up, meet that kind of mark, that 200,000 bogey there for the year? Giga Berlin hit 5,000 cars produced a week. Giga Austin 4,000 cars. So they're kind of trending that in the right direction. In China, you have fewer disruptions like the lunar holiday and maybe lesser COVID infections. So there'll be some positives there. But the question is, do they got to cut more prices again? Do they got to do that again? And that's the concern. I think that's why we're seeing the stock not necessarily reacting that well today. I can't, if I can see that in the pre-market there, but we'll see. I think the issue is that sentiment is the price cuts temporary, or they're going to be needed again.
Yeah, even as we're tracking shares pre-market, as you were mentioning a moment ago, they are down by about 2.8% right now for shares of TSLA. This comes as we did get some delivery numbers that came in from other electric vehicle manufacturers as well. And a larger question of if Tesla is doing this, of course, how does that impact their margins at the end of the day, too? But we've got this as many of the other auto manufacturers are ramping up their own delivery. Rivian delivering 7,946 vehicles in their quarter, too.
Yeah, I'm not sure. I'm not sure if that's an estimate or if that's the real number. I haven't seen that yet. But
saying that they're on pace to meet their annual production.
Okay, yeah, sure. That's good, but I mean, they actually had to raise prices, right? Because they couldn't maintain that margin, like you mentioned.
Right.
Tesla's able to maintain those margins. We saw some numbers by Li Auto too. They're doing well there in China. But the big question is, can they actually keep growing, but also grow profitably without having to engage in a deep price war, which seems to be happening right now in China, and possibly going to happen here soon.
All right, Yahoo Finance's own Pras Subramanian. All things autos this morning, and a lot of auto news over the weekend and this morning. Thanks so much, Pras. Well, there's a new name in live sports entertainment. Endeavor Group Holdings announced plans this morning to join the UFC with WWE brands under one umbrella with an estimated combined value of more than $21 billion. UFC and WWE achieved a combined 10% annual revenue growth rate since 2019. The deal is expected to close in the second half of 2023, and WWE has spent the past several months looking for a buyer. Shares of Endeavor are up pre-market on the news. We'll take a deeper dive into the deal later on in the show. Well, switching gears, there is a lot coming at investors over the next 4 weeks, including a jobs report, a Fed meeting, and, earnings season. That kicks off again. With all of these inevitable market-moving events set to take place, could it be Warren Buffett's annual shareholder meeting that steals the show for the second quarter? You can read all about that in today's morning brief written by Brian Sazi, up now on the Yahoo Finance homepage. But for a deeper dive into what we might expect from Buffett the next month, let's bring in the man on the screen right there, Brian Sazi. He's in the chat.
Yeah, I am excited about this Warren Buffett meeting, talking about being very out in front of the news. That Warren Buffett Berkshire meeting will not happen really until that first week in May. Yahoo Finance will be on the ground. I'm very excited to be out there covering it. But this is the first time we're going to get to hear from Warren Buffett on his view on the bank stocks. Was he in the trenches? Did he want to make a deal? I want to hear from Warren Buffett after all the activity we heard in March and all the big banking and turmoil. Now, in light of these OPEC, oil cuts too, I want to hear what he has to say on oil. Of course, he owns, I believe, 24% of Occidental Petroleum, top ticker on our site this morning, along with Exxon and Chevron. I want to know what Buffett thinks about these cuts. So you take all these things together, and I know this Friday we have a jobs report, and we have a lot of data coming out, investors, this week. We'll have earnings season 2 kicking off in a few weeks from the big banks. But still, I want to hear from Buffett on these two big issues, and I think he's ready to deliver.
All right. Well, we're going to keep this, thank you for that, Brian Sazi, by the way. We're going to keep this conversation going with respect to Buffett and welcome in Gregory Warren, Morningstar Senior Stock Analyst. Thank you for joining us here today, Gregory. Just your thoughts. You were listening to Brian here and some author comments about the oil market, some rumblings this morning. How are you viewing equities as we roll into this new week and a new quarter?
Well, first of all, I agree with Brian here. I think that we're definitely going to have Buffett be able to sort of hit some key topics coming into this year's meetings. It happens every few years where we get a lot of large events sort of happening that affords him the opportunity to sort of dig a little bit deeper. The banks is one big issue here. And I think the oil industry as well, to Brian's point, they own a significant chunk of Occidental at this point. My longer term question on Oxy and whether Warren will answer it or not is a different question, but they've got permission to buy up to 50% of the company, but is the long-term game plan here just for Berkshire to just, acquire it whole, and whether or not that makes sense for them in the long run. And as far as equities go, I mean, it's tough. I mean, I'm their side of the coin. I cover the U.S.-based asset managers, the alternative asset managers, and it's been a tough year in some. I mean, the first quarter ended up being a little bit stronger than our expectations. We were looking for low single to mid single digit sort of gain in the markets. We ended up, sort of, mid to high. Expectation is we're still likely to see, some sort of recession, in the next, 6 to 12 months. And that could have an impact on stocks. And I think, earnings is going to be important. I think the bank earnings are going to be really important to sort of see where everybody is. The regional banks have had a lot of money flowing out. The big money center banks have had a lot of money flowing in. So we kind of have to see where they're situated overall.
Greg, are you surprised that Buffett has not put more of his cash hoard to work in this environment?
Not really. I think he's trying to sort of figure it out, where things lie. I mean, we saw sort of this hesitation during, the COVID outbreak. And I think with the banks, the banks are always tricky because, balance sheet business companies, sometimes you really don't know what you're getting until you get in there. And I think the bigger issue with the banks overall is Buffett is really never going to own, say, more than 15% of any bank, because once they get beyond that threshold, then it changes their reporting requirements, to the regulators overall. And I just don't think that they're going to step into that. I think the key here is, we heard that news break a couple weeks ago about, Buffett talking with the Biden administration and the regulators about figuring out some sort of plan for the regional banks. And it makes sense to me, but I think there's a price that comes with that. Buffett's, stepped in and saved Goldman. They stepped in with Bank of America, but there was a pretty hefty price tag attached to that. You had sort of, anywhere between 8 and 10% preferred stock, and then warrants to buy stock, the common stock as well. So that Buffett seal of approval is not cheap.
And so in the interest rate environment that we find ourselves in right now, and the Fed being extremely clear about its policy pathway with its focus on its dual mandate, what does that mean for the next area that Warren Buffett and Berkshire Hathaway may be interested in setting a large or outsized position?
Well, it's interesting right now because, I mean, you just to sort of continue that point on, why they're not investing more in stocks. They're earning 5%-ish on their T-bills. And their $130 billion in cash that's sitting on the books at the end of last year, most of that's in T-bills. So there really isn't a huge incentive to jump in there unless they can get, a decent return. I'd say probably a 10 to 15%, return out of something with, less risk, overall than they might see in any other environment. So I think, from that position, them sitting on the cash, while we've criticized them, the past decade about sitting on too much cash for a long time, I think sitting on cash probably isn't a bad idea in the near term.
I just want to throw out a statistic from your own notes here that really caught my eye. With the 1.9% yield on Berkshire's average cash in their fixed income investments, their bond investments last year, matching the yield earned on its stock portfolio. This happened for the first time in years. That's really something. Finally, bonds earning the same as much as stocks. What does this say about the environment for Berkshire and its portfolio and, I guess, everything, the merger and acquisitions potential for the future in this environment?
Well, I think the interesting thing for Berkshire historically has been that and most people, when they look at an insurance company, insurance companies are heavy into fixed income, and most of their income is coming from fixed income products. Berkshire's been sort of the complete opposite. Most of their income, interest income, dividend income, has been coming from the stocks that they hold, and with most of their fixed income holdings in T-bills, they were earning next to nothing on a lot of that for a long time. So we've seen this huge swing, overall, which has benefited them from that perspective. And our expectation is that's not going to unwind for a while. I mean, I'm not sure the Fed cuts rates this year. And it's just going to be harder for them to sort of step away from the benefit they're getting there. But I think they're also going to be selective about where they're hunting. Valuations have bounced back. Between the fourth quarter and the first quarter this year, it's a little bit hard to get kind of excited about stocks, where valuations are now. They're already heavily exposed on the growth technology side of things. So I don't really see them stepping on, much more, on that side of the market. My feeling has always been, longer term, that Berkshire is an acquirer of more utilities within North America. They're going to be one of the bigger consolidators within that industry over time. What has kept them from doing a lot of deals the past decade has just been valuation, because when interest rates were near zero, utility stocks, REITs, all of these equities that had good sort of dividends on them were basically, fixed income, equivalents for a lot of investors. But now where fixed income, is providing a decent yield with less risk, we're starting to see valuations on utilities look a lot better than they have in a long time. Just not sure if it's quite where it needs to be for Berkshire to get aggressive about buying up some utilities here.
Hey, Gregory, just while we have you, what does that really set up for this earnings season, and especially with regard to valuations that you were just speaking of? I mean, last earnings season, a lot of the story was just around the fact that the margins or the growth expectations needed to be reset, earnings needed to be reset, and transparency needed to pull through. And so now, does that mean that for valuations, much of the worst is behind us, or do you believe that there's still a little bit more turbulence in store?
I still think we're going to have a little more turbulence. I don't think that the worst is quite behind us yet. I think it has to be seen yet what the impact was from Silicon Valley Bank collapsing, and which created somewhat of a mini run on a lot of regional banks, and whether or not that's going to start pressuring regional economies as well. I mean, I think everybody's going to be paying very close attention to earnings this quarter to sort of see what was the fallout, what was the impact. I mean, banks are, first and foremost at the front of that, but there's stuff on the asset managers, there's stuff on the alternative asset managers, because they had big exposure to venture cap, private equity investing with SVB overall, and whether or not the disappearance of that bank, and a lot of the relationships that it helped sort of maintain and sustain is gone as well. And then the tech sector, the question is, how much disruption did that cause within there? I mean, there's just a lot of little things that I think people are going to sort of want to see what sort of impact this might have had during the first quarter, and whether or not management teams are speaking more cautiously. I think the Fed only raising 25 basis points this last time is probably a good sign that they're closer to the end of the rate hikes than not. And I think we're going to get some management commentary around that as well. Really solid earnings season preview for us as well there. Greg Warren, who is the Morningstar Senior Stock Analyst. Gregory, thanks so much for the time this morning. Thanks for having me, guys. You got it. Coming up, everyone, we've got some Merger Monday action here. MMA for WWE agreeing to merge with the UFC. More letters, words coming up shortly as they form a new publicly traded company. Details next.
World Wrestling Entertainment and UFC owner Endeavor signed a definitive agreement to form a new publicly listed company with a value of over $21 billion. The deal for WWE and Endeavor announced this morning, and some of the details that were really outlined within this release as well. Endeavor is going to hold a 51% controlling interest in the new company, and then existing WWE shareholders, they're going to hold 49% interest in the new company. And then additionally here, just in terms of the distribution and reach, we do know about both of them being international brands. They will have quite the scale and omni-channel distribution that they've discussed as well. And at least as of last year, fiscal year end, they had both achieved revenue of about $2.4 billion and 10% annual revenue growth rate since 2019.
Yeah, just taking a look at this deal, I was looking at the share price right now. It's trading down to $85.50, and the contributing price, according, there you can see on the Wi-Fi Interactive. I'll do some charting in a second. The number I was looking for, UFC and WWE, they're each going to contribute cash into this new company, so that holds about $150 million. Then there's going to be a special distribution of anything over that amount. I think that could account for some of the differences in price that we're seeing here, but we'll need more details. We'll get more details as the deal unfolds here. I do have a quote here from Jefferies on the deal, and this comes vis-a-vis Brian Sazzi. Our first take, we like this transaction, most importantly from a structure perspective, no incremental debt used, as we believe the market is very sensitive to debt levels in this environment. That's because debt is expensive right now. From a fundamental perspective, we like the assets of UFC and also WWE in a world where linear TV is losing market share to streaming. Thus, live sport content is in high demand. And I think that really encapsulates the environment that we're in right now. You think of live TV, well, you got news and you got sporting events. So that includes us and some of these other events. But beyond that, it looks like there are some licensing deals that are up for renewal here, so those could tilt in favor of the direction of the deal. So we'll have to see what comes of it. I did promise some technical analysis. If we could go back to the Wi-Fi Interactive, here is a chart. This goes back, this is a year-to-date chart, basically trading in the upper end of that range, $80 to $95 a share. Here is a match chart, and really impressive to see the volatility that exploded in this stock after 2018 here. Just this big giant box, and it looks like it's on the cusp of potentially breaking out. So these patterns take a long time to form, but could we see a little cup and handle in here? Well, that would make the break to the upside, if that comes, potentially all the more explosive just based on the length of consolidation here.
Well, of course, because it's a deal that's taking place and we know the dollar figure on the deal, there is kind of a limited upside to it as well at the end of the day. I think this deal, I mean, it had to happen, and Endeavor is probably the best of companies that was suited to make this deal. The elements behind it, of course, you had of course, all of the turmoil around Vince McMahon that had taken place and the allegations of hush money payments that had come to light. And so all of those things considered, Endeavor, no doubt, having the time to do its own due diligence and still deciding to move forward with this. And we'll see exactly how that entity fares on a financial basis moving forward from here with some of the distribution and reach that they will have. Here's a look at the opening bell on Wall Street. And there you're taking a live look at the New York Stock Exchange, where the New York Center for Children rings the opening bell this morning. On this, the first trading session of April, we have officially ended the first quarter of 2023 and begun the second quarter of 2023 here with today's trading activity. There we're taking a look at the major averages here in the U.S., the Dow, the S&P 500, and the Nasdaq there on your screen. We've got some early morning movement here on the S&P and the Nasdaq to the downside. The S&P is lower by about 0.1%, Nasdaq by about 0.6%. Dow Jones Industrial Average is the lone gainer as of right now. It's up by about 0.4%, however you want to round it off at home, up by a little more than 120 points out the gate this morning. Jared, for kind of a look at today's early tape, what are you seeing there on the Wi-Fi Interactive?
Interesting way to begin the quarter that we're seeing the Nasdaq really the big laggard here while the Dow is advancing. And if people remember what happened in the first quarter, it was the opposite. That was the Nasdaq was leading to the upside while the Dow was lagging. So we'll have to see if this continues, because this is more a reflection of what happened last year and not necessarily this year. So again, 1 day, 1 minute does not a trend make, and we'll have to keep an eye on this throughout the day. But XLE, energy in the forefront. We've been talking about that OPEC plus surprise deal where they're cutting production, and then XLE, that's up 4% today, not surprisingly, on the back of significantly higher crude oil prices. Materials, financials, healthcare, staples, industrials, all of those are green. Industrials and staples just barely. Same thing with healthcare. Looks like communication services, that's where you're going to find such firms as Meta, Netflix, and Verizon. That's the biggest loser here, 0.8 to the downside. Let's take a look inside the Nasdaq 100, and when this populates, looks like we can see a mostly red board here. We're talking about those Tesla production numbers. Tesla off 3%, a lot more red than green here. So we'll have to see what evolves during the day, Brad.
All right. Let's continue to look through some of the stories that are moving markets this morning. UBS, they are reportedly set to reduce the overall workforce by between 20 to 30% once the integration of Credit Suisse is complete. All the while, prosecutors in Switzerland, they're opening up an investigation into the UBS Group's takeover of troubled Credit Suisse. Now, what's important to know in terms of some of the figures, as many as 11,000, it seems like, employees in Switzerland will be terminated there. And combined, these companies had about 125,000 people that at the end of last calendar year in 2022, 30% of that roughly in Switzerland, though.
Yeah, just some big picture thinking about this deal. It's reminiscent of some of the big mergers and acquisitions that happened in the global financial crisis in 2008, roughly 15 years ago. Back then, we were talking about Bear Stearns. Eventually, it would be Lehman Brothers. And there were banks involved, too, Washington Mutual. Well, this is unfolding overseas. So now we're seeing UBS, this big Swiss bank, absorbing Credit Suisse, kind of the redheaded stepchild of at least of European banks there, beleaguered for a number of reasons. But there are a lot of global implications for this, not the least of which is that UBS is going to have now a huge footprint in Latin America. I was just reading one side story, and this is one of many. UBS in Brazil, $150 billion worth of wealth management. Guess what? Credit Suisse has $80 billion. That brings them to $230 billion. That's going to trounce JP Morgan, which was the number one at $180 billion. So the big get bigger, and the small, well, sometimes they just go out of business, as we've seen with the regional banks here in the U.S. A little bit of apples to oranges commentary there, but I think overall somewhat fair, if you'd agree.
Yeah, I would. And just to add a little bit of a note on the investigation that we were mentioning a moment ago as well, the Office of the Attorney General in Switzerland, they are opening that investigation. And it seems that federal prosecutors there, they were looking for national and regional authorities to also investigate this deal and the consummation of it. Of course, year after year, and we had talked about this even as the deal was going forward. And prior to that, Credit Suisse has had its own kind of yearly, not just tumultuous event, but some type of event that we've had to cover year after year.
Yearly, but unscheduled.
Unscheduled, exactly.
There you go.
And so within the broader banking turmoil and banking concern that had ensued, Credit Suisse was once again found itself just thrown into that, given some of the mismanagement that had taken place there. UBS swooping in, getting kind of a fire sale of a deal at the end of the day.
Yes.
And at the end of the day now, Switzerland authorities also looking to investigate this even further here.
All right, break out the popcorn, guys. Cineworld and certain of its subsidiaries entering into a restructuring support agreement with lenders. That's as it exits basically the equivalent of bankruptcy, Chapter 13. And you can see the shares are down 35% there. If we look at the Wi-Fi Interactive, I can show you a chart here. And this is going to go back, let's see, let's take a look at the one-year chart, already down 94%. Not a huge surprise. It's basically This has been a penny stock for at least 6 months that we're looking at here. Is this going to move the needle on Cineworld? Looks like lenders are going to provide basically $1.5 billion of new debt financing, and then Cineworld is going to raise $800 million through a fully backstopped equity offering. And here is the net result. You can see the share prices on your screen there. And just in the general, I'm going to put a year to date with this heat map, and you can see there's some they got some winners here and a couple of losers, and the winners largely in the U.S. and the not winners, well, it's Cineworld and looks like also National Cinemedia as well.
Yeah, really interesting to see some of the movie and entertainment companies this morning, especially considering the fact that for Cineworld, this was a company that was looking at selling its business. So it's now terminating effectively those efforts to sell its U.S., its U.K., its Irish businesses as well here. Even as we were thinking back to some of our conversations with AMC CEO Adam Aron, they had talked to Yahoo Finance last year about the opportunity to potentially buy up some distressed theater chains at kind of bargain basement prices, and Cineworld certainly was within that conversation, or at least that line of thinking around it. I was taking a look at AMC shares. AMC had since kind of stepped off of looking through those opportunities, or at least deploying cash or capital in that direction in terms of acquiring some of those distressed movie theater operators or even individual locations. But hard not to take a look at AMC shares even this morning in reaction to this news, considering now what Cineworld is going to continue to go through to try and save its business. AMC shares, they're up by about 1.1% on this. It was a big weekend at the box office for me personally. Went to go see Dungeons and Dragons, and so that a boost for AMC, I guess, at the end of the day.
Good for you and them as well. Coming up, trouble at McDonald's. The burger chain reportedly shutting down its corporate offices to prepare for layoffs. And that's all according to the Wall Street Journal. We're going to bring the story behind that to you up next. McDonald's reportedly planning a restructuring. The fast food giant closed all its U.S. offices temporarily this week in preparation for incoming layoffs. And that's according to a report from the Wall Street Journal. Yahoo Finance's Brooke DePalma, she has the latest.
Good morning, Jared. Well, certainly some disappointing news coming out of McDonald's this morning. Wall Street not reacting too much in opening. Shares mostly flat here, but that's right. The burger chain is reportedly planning to lay off both U.S. and international employees this week. In an internal memo obtained by Wall Street Journal, the company said employees should work from home Monday to Wednesday of this week while they deliver those staff change-ups and layoffs virtually. Now, the decision to lay off those employees virtually, part of that reason was due to this being a high travel weekend with most of their employees off. Now, employees who will be out of the office, who will not have access to their computers, were actually encouraged and asked to provide personal contact information in which they will be contacted if, in fact, they are impacted. Now, with this, the company also reportedly told employees to cancel all in-person meetings with vendors and outside parties at its headquarters. But, Jared, it is unclear what teams will be impacted, how large or small this impact will be. And Yahoo Finance did reach out to comment to McDonald's and received no comment.
And Brooke, this comes against the larger backdrop. Walk us through what we have heard so far from the company over the course of this year.
That's right. Well, let's take from a Wall Street perspective. Shares are mostly flat this year, but the larger revamp is really the bigger backdrop that we're taking a look at when it comes to McDonald's. They're aiming to hone in on restaurant growth, operation efficiency, effectiveness, and innovation here. So back in January, the company announced Accelerating the Arches 2.0. That's sort of a revamp, a second innovation of their Accelerating the Arches 1.0. In addition to that, as part of it, they added a fourth D, that fourth D driving restaurant growth, and they also announced Accelerating the Organization ATO. Now, as part of that, CEO Chris Kempczinski sent out a memo back in January saying, quote, as part of this work, we will evaluate roles and staffing levels in parts of the organization, and there will be difficult discussions and decisions ahead. We expect to finalize and begin to communicate key decisions by April 3rd. Now that brings us to today. The memo later on went to say that the company is divided in silos with a center, segments, and markets. And that approach is what they say outdated and self-limiting. Now this comes as that restaurant growth background is a large plan for 2023. The company plans to open 1,900 restaurants and new locations, that is, this year. 400 will be in the U.S., Canada, Australia, and Europe, 900 in China, that is. So certainly betting big there. The company also tapped the Chipotle exec who was coined with innovation and growth at the company. So certainly bringing that here. And in terms of a larger macroeconomic backdrop, Chris Kempczinski said on the call that lower income consumers are trading down, spending less at their stores as inflation continues to take a toll. But McDonald's performing well this year. The company recently beat across the top and bottom line in their latest quarterly results. And so certainly we'll wait to see just how large this layoff round will be and what exactly the impact will be on both its workforce and its bottom line.
You know, Brooke, I just think about their headquarters in Chicago, Illinois, and particularly, or at least in the Chicago area, and what that means for so many employees who will be remaining there. I mean, does this mean that they just have kind of a WeWork set up and say, oh yeah, we just got this kind of McDonald's WeWork outpost that people can come into, or is it purely virtual? How does this vastly change the structure of people who are even continuing to stay on at McDonald's?
Well, Brad, to make it clear, from what I understand, the company will only close its offices, its U.S. offices, from Monday to Wednesday of this week while it does these layoffs rounds. And so while it seems like it's a hybrid workforce here, those employees who are not impacted by these layoff rounds are still encouraged to work from the office once they reopen on, say, Thursday. And in addition to that, as you noted, Hamburger University, as they call their Chicago headquarters, it has such a large presence in Chicago, and so I don't see them closing the office permanently anytime soon.
All right, I would like to get my master's from Hamburger University in the future there.
Wouldn't we all, Brad?
Thanks so much. Appreciate helping us break this down this morning. Brooke DePalma. And coming up, everyone, how do you trade options? What does it mean? And what should you consider for your portfolio? We're your guide for everything you need to know next. Options can be used in a variety of ways to suit an individual's investment goals and risk tolerance. They can be used to speculate on price movements, generate income, or hedge against potential losses. For more on how investors can use stock options to gauge price movements and profit from market volatility, let's get to Simpler Trading's VP of Options, Danielle Shea, for the basics. This segment is sponsored by Tasty Trade. Danielle, great to have you here with us this morning. First and foremost, why would a person choose to have options in their portfolio versus or in tandem with some of their equity holdings?
Well, personally, I like to use options to leverage the stock market. So when you're looking at trading options versus trading stock, one major reason why people will get into it is because you can use a significantly less amount of money to actually get into the stock market. So for example, when I first started trading, I started trading with a $5,000 account, and I was able to make trades using $100 to $500 per trade. Whereas if I was trading stocks, I would have needed thousands of dollars to make the same impact.
And Danielle, with increased leverage, of course, comes increased risk. Maybe you could give our viewers some of the risks attendant to trading options that you might not have when you're trading just equities.
Yes, absolutely. So trading options is inherently risky. And what I like to tell our subscribers and our traders is that whenever you're going into an options trade, you need to go into that trade understanding that that's money that you can lose, specifically when you're looking at the time frame that you're trading. Personally, I'm a pretty aggressive trader, and what that means is that I'm trading on usually a 3-week or less time frame. And so that means that the options that I'm trading are going to expire in 3 weeks. So when you take that into account, you need to think about how much money you're putting at risk. Typically, what I like to say is that I'll risk about 1 to 2% of my account on an overall trade, knowing that, if the trade doesn't go my direction over the course of those 3 weeks, then yes, that is money that you can lose. That's why you have to look at your overall risk tolerance and your overall financial plan to think about if that's something that works for you. But for me personally, being able to take on, 1 to 2% risk per trade on my overall portfolio on about a 3-week time frame, for me, I love being able to capture the leverage that options provides.
Okay, so I imagine that you're sitting in front of your computer, multi-screens, rubbing your hands right now because that 3-week time frame, that cues you right into earnings season as well. How are you using options data to really get a glimpse of how a stock may move when they do report earnings?
Yeah, so one of my favorite times to trade options is going to be during earnings season. And the reason for that is because options are priced on a variety of different ways. And one of the ways is the implied volatility. So the pricing in options is going to go up when implied volatility goes up, and implied volatility is going to go up going into earnings season. This is because there's more volatility around earnings. And so when you know that the price of an options contract is going to go up going into earnings season, what I like to do is I like to time that, and I like to buy those options prior to the earnings report and trade them up into the report. Now, options will go up when implied volatility is going up, but they're also going to go up if, of course, the underlying stock price is going up. So ideally, what you like to do during earnings season is have both of those factors working together. So if you can find stocks where the underlying stock price is going up in addition to the implied volatility, then that can be a really good time to actually buy premium in the options market. But I will tell you that you do need to generally get out of those options prior to the earnings report, because after the earnings report comes out, the implied volatility is crushed. And that means that that options contract is crushed as well. So generally, I like to buy premium going into earnings. And then once you get to the earnings report, I like to actually sell premium to trade that volatility crush.
Danielle, we're using lots of fancy words here, premium, implied volatility. Just wondering, for a new options trader, just dipping one's feet into the waters here, how does one get up to speed on all the terminology and just kind of dip their toes in without risking too much?
Well, I always advise traders to get education, before they get into the options market. And a lot of that is going to come with options 101 education. So primarily, you can get that education online. I do write a ton of blogs. I teach classes as well. But, traders do need to understand how calls and puts work, and they need to understand the basic terminology. So, for example, in the options market, selling premium is something that is very unique to the options market, and that's usually a second step. Normally, what I teach traders is they need to first understand how buying long calls works, and then they need to step up into higher level strategies such as selling premium. But the basic concept really just starts with the fact that, options are leveraged products, and you can trade them using a significant less amount of money than you could just buying overall stocks. And if you can learn how to trade those in tandem with your overall stocks, that'll be much easier for you to then learn how to get into the options market.
Yes, leverage can mean more freedom and also more risk. Really appreciate you breaking that all down for us. Thank you for that. Danielle Shea, by the way. Sponsored by Tasty Trade. We're going to be right back. Welcome back, and turning now to our trending tickers this morning. Artificial intelligence stocks continue their climb on the hype around the technology. This as big tech names like Microsoft continue to drive news around the stocks after announcing a multi-billion-dollar partnership with OpenAI makers of ChatGPT. And Brad, we've been talking about AI in fits and starts. We got interrupted by this big banking panic last month, but ChatGPT has just remained this presence in the headlines. 3.4, the new version 3.4 was just released a couple weeks ago. Magnitudes of order just trouncing the previous version, which was only 3.52. It's just incredible to see the gains. And now we've seen Elon Musk and others calling for a pause. You can read into that however you like, maybe some ulterior motivations, maybe not. But this technology is here to stay. And we're seeing it kind of evolve fits and starts in the investment arena too in some of these smaller stocks.
Yeah, I'm taking a look at the Wi-Fi Interactive on our screen here in studio. I believe you have it pulled up on your screen as well there, and you're taking a look at some of those AI-related stocks. And this is the move intraday here today. And so coming into this pre-market, we were seeing a concerted move higher. Now here, that has swung to the downside. And one of the big news items last week that was driving a lot of the AI conversation, aside from Elon Musk's letter, and there you've highlighted the year to date as well. I mean, that move is, quite frankly, just bonkers. But as we think about some of the larger names that intertwined within that, and they are data center, a lot of data center or semiconductor type of plays, NVIDIA being one of them, or on the generative AI front, Microsoft and their $10 billion investment into OpenAI, that has been considerable. And so the buzz around artificial intelligence certainly has been one of the major stories that has moved from the first quarter now into the second quarter here of 2023. But it's a larger question of where the artificial intelligence of old will continue to be an actual margin generator for some of the companies like IBM, Big Blue out there, Intel that had its own webcast last week and tried to continue to shore up confidence to its investors that it was going to have a major stake or a play in the game here at the same time that they're ramping up spending on the fabrication process and capacity there. And so all of that considered, AI, this is not your father's AI anymore. This is more of this new generative, can, basically write your term paper in a hot second if you wanted it to.
And pass the LSATs as well.
Right, and still have some cybersecurity type of approach to it.
To do at night. Just one more quick look at the Wi-Fi Interactive. Huge difference in the way to play these companies here. You got the big ones, see Microsoft, Alphabet, NVIDIA, even Baidu, and then just about everything else. Some huge variances in the market cap there, Brad.
Absolutely. Well, coming up, why our next guest says current market conditions indicate a resilient economy. We'll speak with S&P Global's Beth Ann Bovino. She joins us next. Welcome back to Yahoo Finance Live. This morning, I'm Brad Smith alongside Jared Blickery. We're taking a look at the latest market action to start the second quarter of 2023 here. So here's a year-to-date view of the Dow Jones Industrial Average. Let's pull this up. 1.4% higher now year to date. And today's move, we're up by about 1% to start off the second quarter. The Nasdaq Composite higher by year to date by about 16.4% right now. However, lower out of the gates to start things off. Right now, we're down by about 0.3%. 40 points is what that equates to. The S&P 500, you're seeing that net higher over the year by about 7.3%. However, this morning, still good this morning. It's up by about 0.3% here. Taking a look, though, at some of today's individual sectors here. And, of course, year to date, the story has been all about some of that bounce back effort that we had seen in communication services and technology. Look at technology year to date. It's up by about 21% for XLK. However, down right now by about 0.1% on today's activity. And then just switching this back over to the intraday here, we'll take a look at some of the biggest leaders and laggards. Energy is actually leading on the day. Of course, that coming after OPEC Plus's surprise decision over the weekend to cut production. And we're taking a look at XLE. That's up by about 4.7%. However, pulling up the caboose, we've got consumer discretionary. That's down by about 0.8%. Utilities also lower by about 0.7%. Want to ride out with a quick look of the Nasdaq 100 here. Big movement lower here for Tesla as of right now. Intraday down by about 4.7%. That is despite a record number that they had seen in terms of the production and delivery figures that were just unveiled by the company, as well as a wave of other electric vehicle manufacturers that revealed their production numbers for the first quarter of 2023. We'll continue to watch that move, as well as the other major tech companies here on the day. Jared, I'll toss things on over to you.
Yeah, really impressive to see that huge difference in the performance between the Dow year-to-date just climbing into positive territory and the Nasdaq 100 up 17%. Well, big Wall Street names are warning of an incoming recession as concerns of rising downside risk for the U.S. economy steers into focus. Investors eye the economic effects from recent banking turmoil, but how deep will this economic downturn run? Here to discuss this and more is Beth Ann Bovino, S&P Global U.S. Chief Economist. Beth, thank you for joining us here today. We can talk about a number of data points. We got payrolls coming this Friday. That's going to be a big one, the big monthly jobs number. What's in your radar as we begin this new week and quarter?
What we've seen so far is that surprisingly the U.S. households have been surprisingly resilient based on, even facing higher interest rates, higher prices at the checkout stand. And that's a positive. But what our concern is when that cushion starts to wear out. Now, what we're looking for payrolls, and that's a difficult one because we do most want to see payrolls start to soften actually job gains start to soften and payrolls start to soften as well, but keep the unemployment rate where it is, keep it still tight. And that's what the Fed is looking for. What we're expecting to see is about a little over 200,000, maybe 220,000 for the payrolls number. The big ticket there is to watch what happens with wage gains. Wage gains, if they remain tight, we are expecting a strong number again, up 0.3% month over month, and that probably brings it at about 4.5 or so year over year. That's really the worry is, particularly for the Fed, a wage spiral going forward.
And so the thing is, it has started to show up a little bit in some of the lower income portions of the economy as well. And so what are you watching for to see when that begins to, or at least that on a sentiment or confidence basis on the consumer, begins to trickle into middle income or even the more affluent parts of the economy as well?
When we look at household savings, I think I mentioned it, that there was a buildup in household savings during the pandemic. It hit about 2.5 trillion over 2019 levels. It has clearly, households are eating into it, particularly lower income households. And we've seen that credit card usage has picked up in order to maintain lifestyle, and that's a real concern. What we have seen though is that the cushion is still a little over 1 trillion, and you see weakness from the lower income households all the way up. Has it hit the middle middle income, not just yet. And certainly high income households are holding on still rather well. The concern, of course, is what happens with those households. Of course, what the Fed needs to do is slow demand, and that's what's happening. But the question is, how fast will that be? And one concern I would mention, we do have a shallow recession in our forecast at this point in time, but my concern is with the Fed pulling off, basically pulling back on higher interest rates because of the banking crises. What that means, what will happen with inflation down the road? Could we see the Fed behind the curve yet again next year?
Well, I guess the corollary or the follow-up question to that then is, what if we have a Fed that is forced to overreact to the current conditions, and you said you have a mild recession priced in right now. What turns that into a hard landing scenario? I'm noting your notes. You think there's going to be a higher for longer stance with the Federal Reserve, keeping that interest rate, keeping its benchmark interest rate higher for longer. Does that ultimately increase the chances of a hard landing, a more harsh recession down the road?
I think that the Fed had planned, I'm not in those meetings, but the way they spoke, they seemed to say that the risk of a they would probably say a shallow recession, a little bit of a hard landing, was in their expectations, in my mind. Now the concern, of course, and I do think that the banking crisis was one bridge too far. They wouldn't allow that, and that sense. So that to me means if they're pulling back on raising rates, there was talk about seeing the Fed funds rate reach close to 6% before the banking crisis. Now we have it. We held it at 5.25% for the Fed funds rate, but we do think because inflation is still real strong, that the Fed's going to have to keep it that high through most of, certainly through 2023 and into 2024. That said, what does that mean in terms of, again, those costs that households are struggling to pay, particularly lower income households? And when households are pulling back on spending, that means businesses can't sell the stuff that they have in their inventories, and that means they have to sell it at lower prices, and that also means revenues are down, and that also then says that unemployment rates will climb higher as well.
When we think about kind of summarizing what we saw in Q1 of 2023 and now even previewing what to expect in Q2 and even further out into the year as well, the CEO confidence and the sentiment among CEOs, they're looking for some type of resurgence or even more resilience in the back half of this year, and perhaps all of the headwinds that we've been seeing to this point, largely in terms of what the Fed policy has been outside of what the international factors have been as well. They're looking for that type of resurgence or resilience. So would you be looking for that as well, or is there something else that CEOs should also be considering right now?
Well, certainly watching what CEOs are very focused on the consumer, whether it's their final, it's direct to the consumer or through different avenues to the consumer. The household consumer and household matters dramatically. So what I think CEOs are going to be watching for, particularly those job numbers, they don't want to see that unemployment rate tick higher. They want to see it coming up, soften a little bit, but they don't want to see a handle that would be over 6% for the unemployment rate. That would be certainly a hard landing, and that would mean there would be a squeeze. The other thing that take into account, everybody wants to see inflation coming down, because when we see those job gains and we look at wages now, we're looking at maybe wage gains. They were year over year at about 4.6% last time. Could it hold up to that level, which is which was the historic amount? If it holds up to that level, in real terms, it's still a negative territory. So that everybody wants to see overall inflation coming down, and the only way that's going to happen is if we see demand weaken. So in other ways, CEOs are kind of can't have your cake and eat it too, I guess the answer to that is.
No, that's fair. Beth Ann Bovino, always a pleasure to get your perspective and insights and analysis. It's Beth Ann Bovino, who is the S&P Global U.S. Chief Economist. Thanks so much.
Thanks.
And coming up, everyone, we got to take a look at one of the trending tickers here on the day. Shares of Wynn Resorts on the move after data shows Macau's gaming revenue surging 247% in March. It's topped expectations for a rise of 205%. The surge driven by the return of tourist traffic as China COVID restrictions ease. Coming up, the state of home ownership, how consumers are faring in 2023 despite a challenging backdrop. We'll speak with the CEO of Century 21. Hey, there you see him. Coming up next. Tesla's latest sales numbers, key manufacturing news, and the jobs report. It's all coming up in a shortened Easter week for the markets. Here's what you need to know. On Monday, the markets will react to Tesla's latest delivery figures. These are the first quarterly sales numbers from Tesla since it started a price war with competitors. CEO Elon Musk said on the most recent earnings call at the end of January that he's seeing orders at almost twice the rate of production. A gauge of the health of the overall economy is out on Monday. Watch out for factory orders and construction spending. And one of the key data points the Fed uses to set interest rates is out on Friday, and that's the monthly jobs report. The job market is expected to soften again, with 240,000 new jobs created in March. The unemployment rate is forecast to hold steady at 3.6%. Finally, a reminder, the stock market is closed on Friday for observance of Good Friday ahead of Easter weekend.
And despite 2022 proving to be a difficult home buying environment, Hispanics increased their home ownership rate to 48.6%. That's according to a new report from the National Association of Hispanic Real Estate Professionals. For more on the outlook for real estate, we're joined by 21st Century CEO Mike Meadler. Mike, thank you for joining us here. Could you just dig into some of these stats for us? Some of them pretty eye-opening.
Hey, Jared, absolutely. So I just came back 2 weeks ago from the National Association of Hispanic Real Estate Professionals down in Washington, D.C., where they just released their home ownership report. Believe it or not, Latinos are the only demographic that consistently grew their home ownership over the last decade. You mentioned the number, about 48.6% home ownership across that group. Urban Institute believes that Latinos will account for 70% of first-time home buyers over the next 20 years. And so I think that's being driven obviously by the cohort in general, their median age being much younger than the general population, and the fact that they increased by about 630,000 new household formations in 2022, which was the largest gain that that group has seen in a decade and the largest among any demographic group. So like many others, they're looking for their fair share of the American dream here and buying a home.
What are you seeing in terms of the real estate that Century 21 is working through right now, and particularly married with the existing home sales data that we'd seen, of course, lagging, but at the same time, perhaps you can give us a bit more kind of real-time data component to this, given where we've seen the average price begin to improve a little bit.
Yeah, Brett, I think we're going to continue to see a somewhat of a challenging year from an overall units perspective. What's interesting is that NAR just put out at the end of February a big leap from January, obviously, at about 14.6% increase in overall sales. And I know that now the pending home sales report has increased 3 months in a row. So kind of away from the bottom that we saw, just call it, in the fourth quarter of last year. But we're still 23% behind where we were last year. And I think for the first time, you're seeing a little bit of a crack in the armor here, where after 131 straight months in a row of year-over-year price increase, we actually started pulling back on median price last month, about 20 basis points. So, there's still, I think, just like your last guest said, with inflation and mortgage rates, there's some guesswork to be done, but there are still a lot of people who are going to be, transacting and buying and selling homes. As we know, shelter's a necessity, and I think there's still a lot of pent-up demand out there.
And I say price improvement from perhaps a potential buyer's perspective here, Mike. I'm still out here doing as many Zillow searches and looking online as I can, as I imagine many other people are, and in different parts of the states here, personally for myself. So where are you seeing the most pickup? Is there any shift in regionality that you're also seeing, even as home buyers and prospective buyers are looking for deals where they can find them?
Brad, it's a great question, and there actually has been, right? We've seen the South, especially states like Texas and like Florida, really being drivers. And just this last month, it's really been the Northeast who has been holding steady and increasing from an overall housing perspective. Just literally on my block this week, yesterday, there was an open house. I must have saw 30 families through that open house. And so I think inventory continues to be the driving issue, right? We're under about 3 months of inventory when a normal market is about 6 months. And homes that, are out there and go to market are selling within 30 to 35 days. So, the serious buyers, the folks who I think have been in the market for a while and are truly looking for that home, are seeing a little bit less competition with where mortgage rates are. But, there's still a lot of folks out there who are looking to buy and sell homes.
And Mike, I just want to bring this back for our last question to the state of the Hispanic homeownership report that we were talking about earlier. Multi-generational living, really a big thing in the Hispanic community. I grew up in Miami, so I saw this firsthand. And I would think as a reaction to these high prices, unaffordable prices that we're seeing, maybe those options, that multi-generational option is being considered more. Just wondering if you're seeing that in the data.
Absolutely, Jared. In fact, the data shows that for the Latino population, multi-generation is about 32% of that cohort, and they are the largest cohort of multi-generation. A lot of co-borrowing as well. So people are getting creative, especially the Latino marketplace, to achieve that dream of home ownership. And you're absolutely right. I think that's what it's taking now with the affordability challenges that we're seeing in almost every market.
What should home buyers be watching with regard to the policy pathway from the Federal Reserve and how that impacts what they're going to be paying and even their financing options?
Yeah, Brad, I say this all the time, right? When you're when you're out there and you're actually renting, you're paying 100% interest, right? And so to me, it's one of the best gateways into wealth building and creation. There's no way to time the market, unfortunately. I was watching what the MBA was saying as far as believing that mortgage rates are going to average and come down. I don't know if that's true or not. But right now, you have to think of it like this. We're still below the historical 50-year average on mortgage rates. If you're looking to buy, if the price is right, make sure you're always monitoring your credit score. Make sure you're continuing to build for a down payment and working with a great real estate professional who's going to help usher you through this big process and the largest financial transaction that most people are going to conduct.
Mike, I think you got to hit me with the Addy for that open house that you were mentioning a moment ago. I mean, you can LinkedIn it to me or something like that, but I might have to check it out myself. Century 21 CEO Mike Meadler. Mike, appreciate the time this morning.
Great seeing you, Brad.
Likewise. Coming up, everyone, the proxy war between Illumina, yes, and Carl Icahn. That continues. We're going to speak with an analyst from RBC Capital. That's next. The proxy battle between biotech firm Illumina and billionaire activist investor Carl Icahn is heating up after Illumina's board claimed that Icahn's involvement could be damaging to the company. Icahn looking to add 3 nominees to Illumina's board after voicing criticisms around the acquisition on cancer detection test company Grail. For more on the proxy fight heating up between Illumina and Carl Icahn, we welcome in RBC Capital Markets equity research analyst Connor McNamara, joined by Yahoo Finance's Anjali Khemlani. All right, Connor, here, aside from having as many Illumina mentions in our intro as possible, perhaps you can walk us through exactly what Icahn is looking to get out of this bid and what Illumina is doing to push back even further.
Great. Thanks for the introduction and thanks for the time. I appreciate it. So, Icahn is looking to get 3 board seats on Illumina's board. And I think ultimately what he wants to do is make sure that Illumina divests Grail, which is a company they tried to acquire, which was one of their customers. And it's facing FTC issues, and it's been a distraction for the company. So I think some of his concerns are shared by many shareholders that Grail has been a distraction. So that's his ultimate goal, and obviously there's been some back and forth over the last several weeks between Icahn and Illumina.
Connor, Anjali here. What's the outlook for Illumina long-term, considering this also faces a lot of pressure in Europe, and it seems that that's where Carl Icahn seems to be focused on this general idea that the company is willing to battle with regulators rather than work with them. What do we think about the prospect of this company looking forward?
Great question, and I think that's one of the distractions that this is causing. Illumina is in the midst of one of potentially their most important product launches ever, something called the NovaSeq X. And it's the least expensive sequencing technology ever released. It has a lot of product updates from their last NovaSeq launch, which was in 2017. And this product, it's our view, is going to lead to a series of revenue beats, earnings beats, and revenue acceleration, which because of this distraction that Icahn's causing, people aren't really focused on that. So we think the overall outlook for the company is fantastic. The sequencing market is still in its infancy. And as we get to this next wave of biopharma investments in things like cell and gene therapy, mRNA technology, CRISPR, sequencing is going to play a very important role in all of that. And Illumina has built this fantastic moat in the sequencing market. And so, those are all good things for the stock, and it's all being, ignored because of this Icahn distraction. So I think ultimately, we're bullish on the stock. We think this product launch is going to go great, and we think fundamentals are finally going to matter. And that's why, that's part of our view on the stock and why we're outperformed.
And so that's, of course, if this all pans out and plays out by the annual shareholder meeting later this year. So looking at, who they're up against, Carl Icahn, well-known activist investor, one of the OGs, if you will, and does like to pick a battle. So what do you think the prospects are here on some sort of agreement or some sort of middle ground being reached where, the board does shift more in his favor?
It's hard to say exactly how this is going to turn out. I think, had Illumina just given him 3 board seats, I believe that would have been a mistake. I think, to have someone that is in there that is focused purely on maximizing shareholder value, which it appears Icahn wants to do, isn't necessarily a bad thing, because the stock has underperformed since attempting to make the Grail acquisition. So I don't think ultimately that Icahn and Illumina will end up seeing eye to eye on a few things. I think that Icahn's going about it in a slightly more aggressive way than I would think is necessarily the best thing for shareholders. But at the end of the day, if Illumina can divest Grail and focus on fundamentals again, I think both Icahn and Illumina shareholders win.
And Connor, let me just ask you, this from your bigger picture term perspective, Carl Icahn, as you've described, just kind of trying to maximize shareholder value, but not necessarily understanding the business fundamentals. How common is this in the biotech world, trying to get activist investors on the board without really quite understanding the business functioning, the heart and soul of the business?
Great question. I think that it happens more than we would really imagine. And so, in some of the interviews that Icahn has made, and in what Illumina has written about their conversations with him, it's apparent that Icahn doesn't fully understand the growth projections for the company. I don't know if the timing was specific, that he did this right before this product launch, or if it was just it happened to be when the financial screens came up for him, and he said now's a good time to step in. But I think that's the primary reason that Illumina can't give up 3 board seats, because this is a long-term growth company in a market that they dominate and that isn't fully understood by all investors. So to give up a third of your board to folks that don't necessarily understand the business or the market, or necessarily even what the company fully does, I think that'd be a mistake. So maybe having 1 board seat isn't a bad thing, but 3 board seats for folks that don't know the business isn't a great thing.
To Jared's point, the biotech in general suffers from that. There's a lot of nuance in it. This market in particular, DNA sequencing, said to be about $40 billion by 2030. So that's a really strong projection and outlook. How does this affect Illumina's potential in the future to do more M&A activity, depending on how this all falls out?
Well, also a good question, because this, they tried to buy another company that does compete in a similar space that makes something called long read technology, whereas Illumina makes boxes that focus on short read technology. That deal was also blocked by the FTC. So now they're trying to buy what is basically a customer of theirs. So they tried to buy a competitor, tried to buy a customer. It looks like neither of those are going to work. So future M&A, that's what other areas can they get into? Probably not going to be one of those 2 areas, but there are some other opportunities. More importantly, they just need to focus right now on executing on the product launch and, get back to revenue and earnings growth. And at that point, I think we could start taking a look at what else is a potential acquisition target for them.
All right. Sounds like we got to get back to fundamentals here. Thank you, Connor McNamara, as well as Anjali Kamlani here. All right. Coming up, we're going to tell you what Wall Street is saying about OPEC's surprise output cut. We're going to dive into the best positions energy stocks for your portfolio.
I think the most important advice during a time of economic uncertainty is be willing to be bold in the decisions that you make. There's no perfect answer along the way. Make that bold decision, move forward with it, and if it does require adjustment along the way, be willing to make that adjustment sooner rather than later. My leadership style has changed significantly over the years. I came into the CEO role in April of 2020, so just as the pandemic was starting. There was no rule book to go by. Being willing to make that decision and adjusting quickly, that's something I practiced very early on and often, and something I'm continuing to do now, especially as we see the economy changing. We can make adjustments to the business and then be willing to continue looking at the economic metrics and understanding what part of the playbook do we need to put into effect. One of the strongest things that I look for in business leadership is going to be a strong sense of business acumen and ability to communicate. The combination of those two, to be able to take what's happening in the economy as well as with the company and be able to communicate that so the organization understands why you're making those changes, is absolutely imperative, and I find is one of the things that really can drive success for a new leader. Continue learning. Stay in front of what's happening, understanding that you're not going to know everything, going back to making adjustments as necessary, but making sure that you're keeping a pulse on your own organization as well as the things that are going on outside so that you can make the best decision with as much information as possible.
Oil surging northwards after OPEC Plus shocked investors over the weekend with a cut of over 1 million barrels a day, leading to a fresh inflation concerns making the rounds here. Yahoo Finance's 3 to 5 anchor Shauna Smith joins us now for a roundup of all the latest reactions. Shauna,
hey there, guys.
Jump in a year for WTI.
Yes, certainly. We're seeing a big jump here in the price of crude, also in a number of these energy players here. So let's take a look at what the street is saying so far about this and their calls on oil and the energy sector after members of OPEC Plus announced that surprise cut just over the weekend. So 2 good notes out today from the teams at Goldman Sachs and also at Stifel. So let's start with what we're hearing from Goldman. That team revising its year-end and 2024 targets for Brent. Now, analysts there up their year-end target for this year by about $5 to $95 a barrel. They also upped their December 2024 target to $100 a barrel. That's $3 higher than what it had previously been. The bank also lowered its OPEC Plus production target for the year for year-end to 1.1 million barrels a day. Now, Goldman making the case that this decision reflects 2 important considerations. Those 2 considerations, economic and political. So on the economic side, they're saying that clearly oil revenues are going to rise when you take a look at Saudi Arabia and also members of OPEC Plus. On the political side, they talked about releases here, recent releases from the SPRs from France and from the U.S. When we talk about SPRs, obviously, strategic petroleum reserves. Now, the other big call out from the street is from Stifel. Now, the team there thinks that OPEC Plus's production cut means higher oil prices, too, at least in the near term. Now, in terms of what this means for stocks, they think that some of these stocks could see a big boost here as a result. Now, they are very positive for their oil service coverage, in particular, some of those U.S. leverage names. They've got a buy on some of 5 stocks here: Liberty Energy, Nextier, Oilfield Solutions, Halliburton, Tenaris, and Cactus. And guys, we are certainly seeing the reaction in the price of crude. When you take a look at where that's trading today, up just above $80 a barrel. A number of those energy names, Halliburton, one of the standouts today, up just over 8% right now. So clearly seeing gains across the board in the energy sector. Of course, the big question I'm sure you guys have been talking about all morning is what this means for the Fed's fight against inflation and how that could potentially complicate those factors here over the next couple of months.
And what the response from Washington will be as well here.
Not pleased.
Yahoo Finance's own Shauna Smith. You can catch Shauna between the 3 to 5 hours here on Yahoo Finance Live. Thanks so much, Shauna.
Thanks, guys.
Also, everyone, Donald Trump's arraignment on criminal charges loom as the former president still looked towards the 2024 Republican presidential primary. Where does Trump stand as the race for presidential candidacy takes shape? Here with the details, we've got Yahoo Finance contributor Kevin Cirilli. Kevin, all right, where does he stand?
Leading the pack. There's actually a Yahoo News YouGov poll that just came out since the indictment charges were announced or made public that there's going to be an indictment rather in the last couple of days. And it has Trump leading at 52%, Florida Governor Ron DeSantis at 31%. So double-digit lead for Trump. All of the other candidates are in single digits and 11% are undecided. Look, I spoke with multiple sources connected to the Trump 2024 presidential campaign over the last few days. They told me Trump's in good spirits, that he fully intends to fight this, that this has been a re-energizing effort for his 2024 campaign. He's been working the phones, talking to members of Congress, where I am this morning, in the Republican Party, and they fully intend to utilize the Judiciary Committee chaired by Freedom Caucus member Jim Jordan of Ohio to put Manhattan District Attorney Alvin Bragg in their political crosshairs. When you look historically at how Trump has fared, anytime he's been up against impeachments, January 6th and whatnot, they've always seemed to fundraise off of whatever scandal is thrown his way. Case in point, over the weekend, the Trump campaign putting out a press release saying that they were able to fundraise $4 million. 25% of that money is coming from first-time donors. of an average size of $34 a pop. So I think the Trump campaign feels that not only has this been energizing for them, but that it also has been a way for them to define their political opponents. Nickname Florida Governor DeSantis, for example, and every other Republican challenger is reacting to Trump. So they feel that they're setting the narrative. In contrast to that, I will tell you this, as I reported last week, I spoke to Corey Lewandowski last week. He, of course, was Trump's 2016 campaign manager and a top advisor in the Trump administration. And he told me that, yes, while Trump feels good about his positioning in the primary field, it's the case here in Washington, not the case down in Georgia, not the Stormy Daniels case up in New York. The case here in Washington pertaining to January 6th, that's where perhaps there's a bit of more uneasiness as it relates to January 6th from Trump's allies as they look to the political future.
So, Kevin, perhaps spitball with us just for a little bit here.
Yeah.
What does this mean in terms of the current elected officials that are in Congress that, if they see polls like this, might change their own stance, their voting, what their tenor is, especially to their own constituents, and how that can also impact some of the very economic policies that are set to be voted for? Oh yeah, let's not forget everything surrounding debt and the debt ceiling in this country too.
Well, look, Congressman Jim Banks, a conservative from Indiana, went on local Indiana radio on Friday and came out to support Trump. So conservatives are using this in many ways to fundraise for their own, to tout their own conservative bona fides. And so I think that, look, it's a primary season. So Nikki Haley, DeSantis, Pompeo, they're all having to jockey for conservative dollars, donors, and support. So I think that that's going to continue to heat up. But if there's anything that the last few days prove, it's that Trump is still the early front runner for this race. As it relates to policy, I'm not sure that the indictment charges or the potential future indictments are going to impact debt ceiling negotiations or other policies. In fact, I would go so far to say that based upon my reporting, they won't, because Congress has typically been able to separate many of those important policy areas. As it relates to the debt ceiling, separately from the Trump 2024 campaign effort, there hasn't been much talk. But last week in an op-ed, centrist Democrat, Senator Joe Manchin in the Wall Street Journal, criticizing President Biden, for what he says is not being able to negotiate or implement the Inflation Reduction Act, particularly as it relates to fossil fuels. There's this interesting centrist conversation happening with presidential politics for centrists about where do they go? Because if it's Trump, they're not going to back Trump. But will they back President Biden in a re-election effort should he announce? And I think that that's brewing. That conversation I would argue would have more of an impact on the policy discussions, whether or not there's a centrist candidate, a unity ticket, for example. That would have more of an impact on policy than I think the Trump indictments.
Yeah, it sounds quite insulating from Manchin, considering that he has been one of the hardest to negotiate with the Biden administration. Yahoo Finance contributor Kevin Cirilli, thanks so much for breaking that all down here for us today. Appreciate it.
Thank you.
Coming up, everyone, why investors are increasingly cautious on the outlook for emerging markets. We'll discuss next.
As we head into bank earnings, there's a phrase you're probably going to hear a lot of. It is net interest margin. So we want to tell you exactly what that means. It's the difference between the interest that a bank pays out and what it brings in. So in other words, a bank takes in deposits from you, from companies, and it pays interest on those deposits. So that's the money that it pays out. Then it also loans out money to you, for your home, for example, to businesses, and then it collects interest as a result of lending out that money. The difference between those two numbers, that is commonly referred to as net interest margin. So in other words, if I'm depositing my money in the bank and collecting 3% interest on that, and then also if I am borrowing money from the bank for whatever it may be, and I'm paying 7%, say, on that loan, the difference between those two, 4%, that's the net interest margin. But to get a little wonky for a second here, the technical definition then takes that number and divides it by the average earning assets at the bank. All that means is all the other stuff on the balance sheet that doesn't really move around that much, stocks, bonds, etc., that's where you get the net interest margin. It's also especially relevant right now with a period of rising interest rates. Why? When interest rates start to go higher, more people want to put their money in savings at the bank because they're getting actually some interest on that for the first time in a long time. And maybe fewer people want to borrow money because it's more expensive to do so. So it's particularly relevant right now, and we're going to hear a lot about it once the banks start reporting.
Welcome back. Investors increasingly cautious about the outlook for emerging markets over the next 3 months amid geopolitical volatility. For more on how investors are feeling on the EM front, we welcome in Murat Ülgen, who is the HSBC Global Head of Emerging Markets Research. Murat, great to have you here with us today. I mean, if we start with the most recent news out of OPEC, how does that pour even more cold water on the emerging market scene?
Well, thank you very much for having me. I mean, as a matter of fact, emerging markets have done pretty well in the first quarter of the year.
Cool.
Maybe more so for fixed income assets. Local debt is up 5%. Currencies help with their carry about 3%. Equities have underperformed. And obviously, we have to see how this OPEC news sort of trickles in, whether it will create winners and losers again based on the rise in oil prices. But our oil and commodities team, they were already expecting oil prices to be about $80 per barrel on average this year, actually closer to 90, given the pretty tight supply-demand balance, which is probably true for other commodity markets as well. But it's a bit early to say. But I have to say, emerging markets have done all right in the first quarter, despite all the volatility.
Yeah, and just looking at the results of your survey, I want to get back to that for a second. Poll finding that 30% of investors feel bearish, and this is up. So slightly more bears from the November survey. That's up from 27%. Bullish expectations falling to 21% from 27%. I'm wondering, do we take this as a contrary indicator, kind of like the American Association of Individual Investors, the AAII survey, where if people are too bullish, that's bearish, and if they're too bearish, that's bullish? How do you interpret this?
Well, we've actually released another survey early March, which actually has been showing investors getting more optimistic about the outlook of EM. Look, we have a survey, what we call an emerging market investor sentiment survey, which we conduct on a quarterly basis across all asset classes, FX rates, credit and equity. Obviously, there are certain variations across asset classes, but overall, the first question we ask investors, how do you feel about the EM outlook over the next 3 months? And actually, in the March survey, that's the latest one we released, investors were getting a little bit more optimistic on the outlook. I mean, underneath, there are some rotations, of course. We can see investors were more optimistic in the December survey about Latin America, which has performed really well. And in the latest March survey, there's a bit of a rotation towards Asia. Perhaps that's the story about China, where the expectation is China reopening and it's the impact to the rest of the world through various channels has many more legs. So yeah, I mean, overall, we've seen in the latest March survey a bit more optimism, but yeah, there are some rotations within the regions.
Within the regions that are getting the most attention, is there one commodity that really has emerged or has really gathered the attention of investors right now?
There is. I mean, if we're talking about themes, it's definitely China reopening, because in every survey we ask investors, what are the key risks to the outlook of EM? And, traditionally over the past year and a half, it's been, Fed and developed market rate hikes, and obviously also the risk of a recession in major economies. And for the first time in the latest March survey, investors thought there is actually an upside risk to the emerging market outlook, and that's the China rebound. And it could actually spill over to the rest of emerging markets. And then we had a bit of a deep dive. Okay, fine. If China is the upside risk, what are the channels of transmission? How emerging markets could be impacted from a recovering China? And nearly half of the investors, they said it's the base metals and tourism. I mean, you ask about the commodity, I would say it's the base metals, because the property market is stabilizing. If anything, actually in March, home sales have grown, home prices are rising. I think there is an expectation of a spillover from there, but also it's tourism. Probably tourism is sort of the area that you would hear most as Chinese tourists travel for the first time in many years, and they've made their bookings, first in the Asian region, but elsewhere as well. That's where the big impact is expected.
It'll be really interesting if those international travel lines just got back to those pre-pandemic levels, outgoing from China as well. We have time for one more. To give you the floor. Anything else that you saw either in the survey or anything in your work that points to something interesting that we should be looking out on the horizon for?
Yeah, I mean, the one interesting thing aside from China rebound, I would say the fact that a lot of emerging market countries, more so the Latin American countries, they've started hiking interest rates a lot earlier than the US Fed or developed market center banks. Perhaps they saw what happened in the past with high and volatile inflation, and this time they've taken steps a lot earlier, which clearly was the right policy choice. And in many of these countries who have started hiking interest rates earlier, who have already accumulated a lot of monetary tightening, we are seeing downside momentum in inflation and positive real rates, which actually you cannot find in the developed world, which is helping emerging market currencies. As I said, in the first quarter, EMFX is up 3% if you include the carry, and 2% spot return against a benign dollar, which is not a bad return. And that, to me, is on the one hand, China rebound, possibly helping through commodities and elsewhere on the external balances. That's what's projected going into the future. But on the other hand, there's relatively high carry at play, the fact that emerging market central banks have hiked interest rates a lot earlier, particularly in Latin America.
Murat, just lastly, while we have you, for investors that are listening to the demand from electric vehicle producing companies that are looking at emerging markets, are the emerging markets a safe play, and are there specific ones that stand out with regard to lithium production versus others?
There is a specific one, Indonesia. It's been already a great macroeconomic story. I mean, this morning they've announced their inflation, core inflation is below 3%. It's really very low by international standards. You have positive real rates, you have strong external balance, good fiscal policy, and Indonesia attracts significant amount of FDI because it has all these, minerals and the elements that you mentioned, like lithium, cobalt, nickel, etc., to produce batteries for electric vehicles. So it has a very solid capital account, balance of payments position, and attracts substantial amount of long-term capital FDI. So I would definitely underline and emphasize Indonesia here.
HSBC Global Head of Emerging Markets Research, Murat Ülgen, thank you so much for joining us here today. With this look internationally here, we can all use it here. Thanks so much.
Thanks very much for having me.
And coming up, everyone, a new note from Laura Martin says Alphabet should be broken up to give shareholders better value. We've got a conversation with her later today. Stay tuned. A lot more to come here on Yahoo Finance today. Rochelle Akufo going to be with you for the next hour of trading. The oil market is in shock after OPEC Plus producers made a surprise decision to cut output. We've got you covered on all things oil with more insight into what Wall Street is saying. That's next.
And activist investor platform Tulip Shares is taking aim at Nike. The company wrote an open letter to the retail giant criticizing its treatment of workers and supply chain production. Rochelle is going to sit down with Tulip Shares founder and CEO and hear all about this shareholder proposal.
All right, all things swoosh there. We've got all that and more. Rochelle Akufo got you for the next hour of trading from myself and Jared Blickery and the rest of the crew. We'll see you tomorrow.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. OPEC Plus shakes up more than the oil market. A major production cut aims to offset the drop in demand, but it might as well cause a big headache for the Fed. Nothing like an unexpected twist to kick off the second quarter. And merger mania. The WWE combines with the UFC to create an Endeavor-controlled entertainment powerhouse. Will Vince McMahon's business stick to the script, or will there be tension between the likes of Dana White and Ari Emanuel? We will discuss. And it's been a strong 6 months for shares of Nike, so you'd think investors would be happy with the direction of the super brand, but not all. We speak with an activist platform calling for more transparency in the supply chain. Don't miss it. But first, let's check in on the major indices 90 minutes into the trading day. Become a mixed picture here. First, we saw open the day in early territory, all in the green, but we've seen some selling action picking up here. Only the Dow right now in positive territory, up 0.6%. The S&P losing ground there, 0.10%, down about 4 points on the day. Tech-heavy Nasdaq there seeing the heaviest losses so far, 0.8%, as they sort of digest some of this oil news, wondering what that means longer term for the economy. Let's also take a look at treasuries as well, see how they're faring this morning. We did see some flight to safety here. You see that the 5-year down just slightly there, just about 2.3% there. The 10-year down 1.89%. The longer term 30-year yield down over 1%. As we mentioned, the oil prices spiking after OPEC Plus members announced a cut to production by an additional 1 million barrels per day. It comes amid a price slump in the aftermath of SVB's collapse and ongoing speculation over demand destruction. The cuts could well raise gas prices in the US and affect an already tricky battle with inflation. Here to explain, Yahoo Finance's Ines Ferre. Hey, Ines.
Hey, Rochelle, and just taking a look at what Wall Street analysts are saying about this surprise announcement, they are basically now expecting oil to go up through the end of the year. So you're looking at now forecasts for price targets for crude oil from Goldman Sachs, now them raising their forecast to $95 a barrel, up from $90 a barrel. For 2024, the end of 2024, Goldman is expecting oil to reach $100 a barrel, up from $97 a barrel. Also, you've got Capital Economics, which is also raised its forecast to $90 a barrel, up from $85. Now, what this does for gas prices and diesel, which so much affects the cost of goods and services. Well, Andy Lippo from Lippo Associates is saying that if oil goes up by $5 per barrel, then you can expect gasoline prices to go up anywhere between 12 and 15 cents a gallon. The timing of this couldn't be really worse because we are going into the summer driving season, spring and summer driving, and also you've got hurricane season, which is coming up in a couple of months. Now, what could central banks do because of this? Because inflation is expected to perhaps rise if you are seeing energy prices going higher. Well, the reaction from central banks could be hawkish. But remember, if the reaction is hawkish, then that would slow down economies and then that would reduce demand for oil. But keep in mind that the Fed also looks at core inflation. This is the cost of goods and services, excluding the price of energy and food. So if the Fed is looking at core inflation, perhaps it won't deter the Fed from continuing on with its path, which appears to be a slowing of rate hikes.
All right, thank you for that update there. Ines Ferre there for us. Well, let's get a wider perspective of how these cuts are set to affect energy prices and even hit interest rates. Joining us now, Matt Smith, Kepler lead oil analyst for the Americas. Thank you so much. So, Matt, I mean, we're looking here at this surprise cut here from OPEC Plus. I want to get your reaction to it and what you think prompted it.
Well, I think, Rochelle, it's just been this expectation from OPEC Plus, and particularly from the Saudis, that demand growth isn't as strong as they expect it to be going forward here. And so because of that, they're just going to take barrels off the market. We saw this happen in October as well, when OPEC made a 2 million barrel a day cut. At that time, there weren't like immediate signs of demand weakness. But in retrospect, they were absolutely right to make those cuts. And still, we've seen prices moving lower here. And so now, given what we're seeing, they're essentially targeting prices, right? And so they want a price in the 80s, essentially, because it meets their budgetary needs. But it also means that prices aren't too high so that they cause demand destruction. So there really is that sweet spot in the kind of the mid 80s there on a Brent basis. So that's what they're targeting. And they're thinking that if they didn't make these cuts going forward here, then prices would continue to drop lower.
It's interesting because we did see that the Financial Times was reporting that some sources think that Saudi Arabia was a bit annoyed with the Biden administration, publicly saying they weren't going to replenish the strategic reserves after saying that they would make, after making reassurances that they would. What do you think of that? Could there be some political aspects in here that could also be factored in?
There could be. I know that some people are pointing to this cut and saying, well, look, it's going to be taking so much production out of the market through the rest of this year. It's essentially a natural offset for the SPR release that we saw from the US last year. That may be the case. It may not. Regardless, OPEC is focused on stability in the market here. They don't want choppiness. They don't want volatility. They do want a price in the 80s. And so regardless of the politics, they are going to be doing what is in their best interests. And in their best interest here is to take barrels off the market to get prices that little bit higher.
So what's your longer term outlook then for energy equities? Obviously, we've seen this jump right now.
Mm-hmm. I suspect we see them faded in the same way as we see that for the oil price too. So you have a situation here, Rochelle, and basically for 2023, where you have China coming back into the market, you know, providing that demand growth strength. The complete offset for that is the Western world hiking interest rates both in Europe and in the US, and the lagged impact of that is going to be causing slowing oil demand, slowing economic growth, and so potentially recessionary conditions. And so those two things mean that we should see prices around this kind of low 80s level through this year here. That's our expectation. We should see some strength as we go into summer here with summer driving season, refineries coming out of maintenance and really running hard. But the back end of next year is likely to be weaker than the front end here. And so in terms of energy equities, I would recommend fading them essentially, because we've had a really good pop across the board here. We should see a bit of give back after today.
Obviously, consumers probably seeing these headlines crossing and wondering, what does this mean for prices? March and April, as you mentioned, that's when refineries are cranking up some of their summer blend gasoline. What are the expectations for how this filters down at the pump?
Well, you typically have a seasonal trend of gasoline prices rising ahead of summer driving season there, so through March, April, May time. And so that would be happening even if oil prices were remaining flat. And so with this announcement, this is going to provide a bit of support for crude prices. And as we know, with prices at the pump, they shoot up like a rocket, but float lower like a feather. And so this is going to provide a bump at the pump, essentially. We're at $3.50 on the national average now, so we should expect it to continue ticking higher here in the next month or two, perhaps heading towards that $4 a gallon level there. So in summary, higher prices, basically.
And obviously, energy is a global story, and it has been stoking some potential for reflation fears. But it sounds like you think at some point this is going to end up fading then. So for people who are concerned about how this will affect inflation and perhaps whether it will be essentially another tightening for the Fed, as we do see this crunch on the dollar as well, what are your expectations?
The Fed is going to stay their course, right? They're looking at quelling inflation over everything else, and that's going to be to the detriment of economic growth here. And so economic growth slows. You'll see that reflected through whether it's a series of dominoes with the housing market, with jobs, et cetera. And so because of that, that's ultimately going to impact oil demand. And so that should weigh on oil prices in the back half of this year. That's essentially because of the negativity in the broader economic backdrop here. And so not really great news for prices, because even if we are seeing them lower, it's because of weaker economic conditions.
I'll certainly be keeping an eye on that. Matt Smith there, Kepler lead oil analyst for the Americas. Thank you for joining me this morning. All right, turning now to our trending tickers. McDonald's temporarily closing its U.S. offices this week ahead of expected layoffs. This according to the Wall Street Journal. Investors boosting the stock on the news, though. And for more, be sure to tune in at 11:30 for a chat with Andrew Charles of TD Cowen. And a new contender emerges in wrestling, with Endeavor Group Holdings brand UFC set to merge with WWE in a $21 billion deal. This move ends months of turmoil for the WWE after scandals involving its controlling shareholder, Vince McMahon. All right, let's stay tuned here because coming up, downside risk. Tech has emerged as something of a safe haven in recent weeks, but is the rally overdone? Morgan Stanley's Mike Wilson thinks so. We'll discuss some top names that could be primed for a reset next. So as we head toward another results season, is the direction of the market really nothing more than a coin toss? Here with insights, Sam Stovall, Chief Investment Strategist at CFRA Research. Good to see you, Sam. Obviously, markets have had a lot to contend with over the past few months. So give us your gauge then. Is this a coin toss for the markets right now?
Well, I don't really think it's a coin toss. I think in many ways you could look to history for some sort of guidance. We are now in the third best quarter of the 16-quarter presidential cycle. And the last two that we were in, which each were both up by 7% or more, were numbers 1 and 2. What we also find is that in the second quarter of calendar years, heading back to 1990, all sizes, styles, and sectors were in positive territory within the S&P 500. And then lastly, April is the best month of the year. So you could basically say that history is telling us that we at least have one more good month to go in this rally.
Are you surprised at how well the S&P 500 has done despite some of the upheaval we've seen?
Yes, I am, because both of those fourth quarter of last year, first quarter of this year, up 7% plus, was certainly better than the historic average. And also, when you look at the fact that we're now entering into an earnings recession. We saw that earnings were down by about 4% in the fourth quarter of 2022, expected to be down 6.5% in the first quarter of 23, which is soon to be reported. And then also taking a look at the second quarter, which is expected to be off by 6%, it just implies that we are moving ever closer to a recession.
So then what do you think the bulls and the bears are honing in on at the moment?
I think the real question is, how deep will the recession be? And I think one of the main factors will be how long does the Fed continue to raise rates? Right now, the street is expecting one more rate hike by 25 basis points in May. Our belief, however, is that they'll raise rates twice, May and June, and they'll wait until 2024 before cutting interest rates. So maybe the enthusiasm will be toned down a bit as we move forward into the challenging May through October period. But I still believe that 12 months from now, share prices will be higher.
And of course, it seems like an eternity. We have to wait until the FOMC meeting in May at this point. And add to that, of course, we're kicking off this quarter with this surprise output cut from OPEC plus. How does that perhaps shift things for you?
Well, it doesn't really shift it. It actually sort of confirms that we're likely to see 2 25 basis point hikes. Prior to that, I was sort of wondering, well, maybe we're getting it wrong. Maybe we will only have one more rate hike. But with oil prices likely to be moving higher, our expectation is that we'll see about $85 per barrel by the end of this year. That continues to put upward pressure, or at least stabilizing the headline as well as the core numbers. So inflation will continue to be a thorn in the Fed's side. And I think that they're going to make sure by maintaining higher rates for longer that they can be able to put a stranglehold on inflation.
And as we know, the US dollar and oil have an inverse relationship. We saw as oil was rising, the dollar index started to come down. It does make imports and other sort of dollar sensitive purchases more expensive. How do you think that tightening also factors in then? Is this perhaps doing a bit of the work for the Fed?
Well, interesting point. You were asking about the stock market itself and a coin toss. You could say, well, it could be a coin toss in terms of what's going to happen with inflation because of higher energy prices, because not only does higher energy prices cause a pickup in inflation, but it also creates demand destruction. So as interest rates move higher, as oil prices move higher, we find that companies, consumers will likely cut back on their energy usage. So that could end up making this spike in oil prices be sort of a fleeting situation. So I would tend to say that while the longer term direction for equities is higher, I think that oil prices are probably going to be tracing out a more jagged pattern.
So then, Sam, where do you see the opportunities going into Q2?
Well, going into Q2, I published an article this morning looking at those groups that tend to be outperformers. So such areas as auto parts and equipment, a company like Borg Warner, we have a strong buy recommendation on. Consumer finance, American Express, also a strong buy. Even prior to hearing the news on oil prices, EOG Resources, because oil and gas exploration and production have done well. These are sub-industries within the S&P that have done very well over the last 20 some odd years.
Certainly be paying attention to those. Always great to have you on. Sam Stovall there, Chief Investment Strategist at CFR8 Research. Thank you for your time. Well, those who said 2023 would be a sober year for tech probably didn't expect the kinds of returns we're seeing for industry giants like Nvidia and Meta. Did we get in over our skis, though? Or is there more upside ahead? Yahoo Finance's Jared Blickery looks at the best and worst performers. Hey, Jared.
Hey there. Well, if we take a look at the S&P 500 sectors year to date, one thing that stands out, it's really the mega cap sectors that have performed the best. And those sectors also happen to can include some of those tech and growth sectors that we talk about, the chips and the software stocks. XLK, that is tech. That's up 20.5%. On its heels, communication services, you're going to find Meta, you're going to find Verizon, Netflix, a hodgepodge of the old telecoms, as well as some what we would call tech stocks. Meta, maybe not a tech stock specifically, but we can kind of lump it in there. XLY is Amazon and also retail stocks. That's consumer discretionary. Those have been the big outperformers. What has not performed well this year is everything that performed well last year. Financials, healthcare, energy being the one huge staple. If we take a look at the one-year trailing trends, you can see energy, the only thing still in the green over that time period. And a lot of what happened this year is on the back of falling interest rates. Here's a 10-year T-note yield, what it's done year to date. Now, you can see it started off around 3.75%, had this rise in February, then during the banking panics that we saw in March, had this steep decline, and that really facilitated that growth trade. That's where the mega caps really took off and started outperforming. So the big question is this going to continue? Well, rates would have to plunge below this well-established support line. So it can happen, but it would probably take another big catalyst to do so. Also, another thing I'm watching is the US dollar index, because this weekend, the Dixie weekend, and that is supported of risk factors over the month of March. For it to continue that decline, it would also have to take out some support here. And it looks like it has some pricing, some price memory just below that. So all in all, it's going to take some movement down in rates, going to take some movement down in the dollar if we're going to see this resumption of the growth trade in the second quarter here, Rochelle.
And Jared, historically, April is a favorable month for the market. So what's your take on the month ahead?
Yes, the second best month of the year, historically speaking, going back to about 1950. We were just talking to Sam Stovall over at CFRA about these stats. And here's Callie Cox over at eToro. As a market historian, I feel obligated to tell you that April has been the S&P 500's second strongest month for returns, and that is second to November. One thing I want to highlight in here, this is something that Sam brought to the forefront, is that from May to September, that is a bad stretch for the market, historically speaking. So that's what a lot of people are trying to avoid. There's the old saying, sell in May and go away. A lot of people just hedge and kind of forget about their positions or don't tightly manage them over the summer. Nevertheless, bottom line, April, historically a good month for stocks. So that is a tailwind for the days ahead here, Rochelle.
We'll certainly be keeping us busy this month then. Jared Blickery, thanks so much. Well, in the wake of last month's banking turmoil, regulators are watching closely for potential weak spots in the sector. Yahoo Finance's Jennifer Schonberger sat down with Consumer Financial Protection Bureau Director Rohit Chopra on Friday, who weighed in on the potential new regulations for these big tech firms. She joins us now with that exclusive conversation. Hey, Jennifer.
Good morning, Rochelle. Consumer Financial Protection Bureau Director Rohit Chopra told me in an exclusive interview on Friday that the Financial Stability Oversight Council, which he sits on, needs to seriously consider overseeing big tech. He says he's concerned banks' over-reliance on big tech's cloud service providers could pose risks if there are interruptions that could freeze the payment systems.
You really worry that if something were to happen, could it really take down a lot of core financial infrastructure? And what might be the consequences of that for the economy and society? You almost want to think about, what if there was a major attack by a state or non-state actor? What if there was some sort of outage? There is so much concentrated in a few major cloud providers. So ultimately, there needs to be a look at resilience, but also financial stability. And in as much that the financial regulators need to take action, I think we have to seriously consider that.
Chopra also weighed in on the CFPB's forthcoming report on big tech's online payment systems and how they use data. I will have more on that and what he said about stablecoins and whether they should be designated as systemically risky in the second part of my interview with Chopra, which will air this afternoon at 4:30 p.m. So please tune in then. Rochelle, back to you.
Will do. Jennifer, thank you so much for joining us and with that update. All right, coming up, it's been a strong 6 months of shares for Nike, so you'd think investors would be on a high. Not all of them. We speak with an activist platform calling for more transparency in the supply chain. Don't miss it.
I think the most important advice during a time of economic uncertainty is be willing to be bold in the decisions that you make. There's no perfect answer along the way. Make that bold decision, move forward with it, and if it does require adjustment along the way, be willing to make that adjustment sooner rather than later. My leadership style has changed significantly over the years. I came into the CEO role in April of 2020, so just as the pandemic was starting. There was no rule book to go by. Being willing to make that decision and adjusting quickly, that's something I practiced very early on and often, and something I'm continuing to do now, especially as we see the economy changing. We can make adjustments to the business and then be willing to continue looking at the economic metrics and understanding what part of the playbook do we need to put into effect. One of the strongest things that I look for in business leadership is going to be a strong sense of business acumen and ability to communicate. The combination of those two, to be able to take what's happening in the economy as well as with the company and be able to communicate that so the organization understands why you're making those changes, is absolutely imperative, and I find is one of the things that really can drive success for a new leader. Continue learning. Stay in front of what's happening, understanding that you're not going to know everything, going back to making adjustments as necessary, but making sure that you're keeping a pulse on your own organization as well as the things that are going on outside so that you can make the best decision with as much information as possible.
UK-based activist investment platform TulipShare is calling for Nike to implement contract clauses developed by the American Bar Association to protect workers in international supply chains. Now, the company, which owns 276 shares of Nike, has filed a shareholder proposal ahead of its annual general meeting. It asks the mega brand to oversee and issue a shareholder report to assess the effectiveness of its supply chain and ensure alignment with its human rights commitments. Yahoo Finance reached out to Nike for comment. Joining us now to discuss is TulipShare founder and CEO Antoine Argouges. Thank you so much for joining me this morning. So I want to first ask you about what prompted this. Obviously, I know that you've said in your note from TulipShare that some of those initiatives that you've seen from the UN are being implemented, but what are the ones that you would like to see Nike do more on?
Well, realistically, for everyone to understand, in the supply chain of such a big company like Nike, you have the tier one supplier, which are basically the last end of the funnel. Then you have the tier two producing the manufacturing good, and then the tier three, which are producing the raw material. What we're asking here is Nike to disclose and update its internal control policy effectively on the tier two and the tier three of the supply chain, which is impacting its most vulnerable workers.
And you do have 5 recommendations that you've put in that report. Walk us through them. I know one of them is assessing the existing policies, as you mentioned there, but also consistency with the OECD guidelines.
Absolutely. I mean, there is a lot of materials out there for Nike to pull from in order to update its internal policies. We think a company such as Nike, which is very innovative in its supply chain, is also innovative in the control of its supply chain and should definitely update according to the American Bar Associations, the OECD guidelines, some human rights principles, which we know for sure Nike is not respecting all of them, even according to their internal audit. So now, we've assembled enough shares to be able to go to the AGM. We've reached out to Nike multiple times in order to get response and progress on this, with absolutely no engagement from the company.
And we did reach out to Nike as well at Yahoo Finance and weren't able to get a response at the moment. But so far then, are there any other activist investors really pushing for these same initiatives?
There is a lot of people pushing to improve, obviously, social commitment and workers' rights, not only in the supply chain, but across the whole value chain. You have a lot of voice now that are saying that being an active investor is going to destroy shareholder value. And that is absolutely wrong. We believe that on the long term, rising and improving social commitment and workers' condition will drive shareholder value up. Not doing so oppose a huge risk, potentially on consumer demand. You never know what happens with tier 2 and tier 3 suppliers. If a scandal happens, then this can come back onto consumer demand and therefore impact shareholder value and share price.
So Antoine, if you don't receive any sort of response or an appropriate response from Nike, what would the next move be?
We haven't received any response so far. Nike has been completely ignoring us. This is why we filed this shareholder proposal, which, we've already filed shareholder proposal at multiple large organizations, such as a very successful campaign at Apple, at Johnson & Johnson. Last year, we received 44% voting support at Amazon to improve working condition in the fulfillment center. So really here, it's about asking for every other shareholder at Nike their opinion. Where do you want to stand on this issue? Do you want to be on the right side of history or on the wrong side of history? And if Nike doesn't want to engage with us, then it's going to be a decision that's going to be made by every shareholder.
And what about consumers themselves? Is there any sort of outreach that you're doing for consumers to become aware of this so that they can also perhaps chime in here if the idea is to get more pressure on Nike to act?
Absolutely. Everyone should be involved into this. It's the rising tides that raise all the boats. We have a consumer platform that allows everyone who's a shareholder to show support to one of our campaign. You can access our website and bring your support wherever you are owning your shares, whoever you are. It doesn't depend if you're a small shareholder or a massive institutions. You can tag along and bring support. This is really it's now a shareholder matter, and it's going to have to be discussed and decided in between shareholders.
And when you think of, I believe in your notes, you said 27.6 million people estimated trapped into forced labor here. How much of an onus is there when Nike is trying to sort of balance bottom line with also shareholder responsibility and the issues that you're bringing to the table here? Is there just a concern that it's not going to be worth Nike sort of taking up your cause if it's not affecting their bottom line enough?
The share price is down already 9.7% in a year, so it did not wait for our shareholder proposal to actually have an impact. So we believe that it's the opposite. It's actually pushing for stronger environmental and social commitment that is going to drive up customer demand and provide a significant better return for shareholder value. Down the line, it's going to have an impact on the bottom line. It's the opposite, not doing anything, the inaction and business as usual that could have a greater negative effect.
I do appreciate you taking the time to join us this morning. Tulip Chef founder and CEO Antoine Argouges, thank you so much for joining us on Yahoo Finance. All right, coming up, ticked off. Elon Musk shooting from the hip once again, this time slamming the New York Times after it refuses to pay for verification. Musk says the organization's, quote, propaganda isn't interesting. The story is, though, and it's up next. The turmoil at Twitter continues. Taking a look here, we see Elon Musk following through with his platform's promise to start removing blue ticks from non-paying accounts. But the rollout, or is it a rollback, has been controversial. Here with more, Yahoo Finance's Dan Howley. Dan, what's the latest?
That's right, Rochelle. We're seeing now some movement as far as those blue check marks go, the verification check marks that Twitter is traditionally used to provide individuals such as journalists, celebrities, government officials, a verification that they are who they say they are. We're starting to see some movement as to those finally coming down. Elon Musk had said that in order for people to have those on Twitter, they would have to pay the fee. I believe it's $7 a month to be able to have that. $8 a month. And so they're going to have to sign up for Twitter Blue to get that verification badge, and eventually everyone's will start falling off. The only problem is the one that seems to have come off first is from the New York Times, after they said that they won't pay the $1,000 institutional fee for a gold check mark. Basically, if you're a large organization, you would have a gold check mark if you're an individual blue. And then if you were a government organization, you would have gray. New York Times, a number of other organizations said that they wouldn't be paying for it, as well as individuals like LeBron James. But apparently Elon Musk not happy with the New York Times, and so he took it away immediately and then had some comments about it as to their coverage and their ability to, I guess, run a journalistic organization. Some, interesting verbiage used, but I think this is just another instance of this company seemingly having trouble getting things done. This is part of their effort to draw revenue from places that aren't just advertising. We've talked about in the past how advertisers have pulled away. Twitter's having a problem getting them back. The advertising industry in general wasn't doing very well. We'll find out in the coming quarter if it's starting to rebound or not. But, this is something that, look, if they're going to try to raise money, I don't know how $1,000 here and there from some organizations, $8 here and there from some users is going to really supplant the enormous tens of millions of dollars they were drawing as far as advertising revenue. So, it is interesting just to see, though, that this process, which was supposed to be basically, everyone kept saying, okay, April 1st, you're going to lose your check mark. And now, it's April 3rd, and I still have a check mark myself. I'm sure you guys do as well.
Indeed, and it's interesting that this obviously did seem to be something of a personal attack against the New York Times. And as you mentioned, not all of the New York Times, I believe it's just their main account. I believe their business news account does still have that verified check mark. But does this really set a tone for sort of picking and choosing if this hasn't been rolled out across the platform?
Yeah, and I mean, it's interesting because when he was coming on, he was saying that there was going to be essentially a fair leader. And it seems as though, he's picking and choosing here. He's also run polls saying, should he be the CEO? Should he not? Should he let people on? Should he not? Saying that he would abide by them. Now, in the future, he says that verified users will be the ones that will get to participate in polls that seemingly have a impact on the way the actual business is run. So we'll have to see how that goes. It looks like it just kind of changes on his whims at the drop of a hat.
Never a dull day for Elon Musk, indeed. Dan Howley, thank you so much. Right, well, one top story that we're following, McDonald's signaling layoffs are coming with the temporary closure of all its US offices this week. That's according to the Wall Street Journal. Earlier this year, the company said it would begin layoffs by today. Let's get to a roundup of restaurant news now. Joining us with more, Andrew Charles, Consumer Restaurants Managing Director at TD Cowen. Thank you so much for joining me. So, Andrew, I want to first get your takeaway. I mean, we knew that some of these cuts were going to be coming, but talk about this journey to get here for McDonald's.
Yeah, so thanks for having me today. The biggest takeaway I would say is that this is part of the company. They flagged there'll be an investor day later this year where they'll deliver some news to the street. The two key pieces there are accelerating store development along with finding G&A efficiencies. And so this shouldn't come as a huge surprise. This is likely in the latter camp of finding G&A efficiencies. McDonald's has a larger G&A infrastructure relative to its quick service peers, whether you look at that as G&A as a percent of sales or G&A per store. McDonald's does run heavy versus peers. As this is an opportunity for them to not only reduce their G&A, but also presumably find some more quicker decision making within the organization, a move not that dissimilar to what Wendy's decided to announce earlier this year as well.
And where could they be putting their investment dollars better to work? We know a lot of companies streamlining here, looking for some efficiency.
I wouldn't say if it's better, where they could put better dollars to work, but certainly digital is something that they are totally focused on. Represents about 25% of the U.S.'s sales and closer to a third when you look at their top 6 markets around the world. And so this is as we know from the restaurant industry, digital is a plant that needs constant watering. And so we'll certainly see more investments behind digital as they get more focused on data and more focused on, one-to-one marketing. Certainly there's an opportunity, I would say, to continue to invest behind this. And it's McDonald's. They're the biggest restaurant company in the world. Certainly you'll see them obviously make a pretty big mark here and obviously do things in a very unique way, just given the resources.
And for people who are wondering, obviously we've been focusing a lot on tech layoffs. It's a different though situation here for some of these restaurant brands.
Yeah, it's kind of apples and oranges when you compare it to tech. And so, I would just point to the fact that this is an opportunity that falls in line with the G&A efficiencies that they talked about earlier this year. Opportunity to move a little bit faster on the decision-making side. And certainly, as you mentioned earlier, the reinvestments they're going to be making into things like digital to help them grow as well, and store development for that matter too, is an opportunity to really accelerate the top line for them.
I also want to talk about Restaurant Brands International. They got an upgrade there to outperform, and the Cowen note saying, putting the brand back together. Break that down for us.
Yeah, so we're really excited about Restaurant Brands. As you mentioned, we upgraded it on Friday. And what we're really excited about there is that the key investor focuses on Burger King US, despite the fact it's about 20% of the adjusted EBITDA of the company. And they're undergoing a turnaround there. It's been a long time coming, following years of underperformance from 2017 through 2022 for the brand. What gives us a lot of confidence about that is that they've got the U.S. president that came from Domino's back in 2021, that he's kind of put together the right team and the right playbook. And what's really exciting is really the oversight you're going to see from the new executive chairman, Patrick Doyle, who joined back in November, and just the home run track record that he had at Domino's during his time there as CEO from 2010 through 2018. And so we're really excited about just the opportunity, I would say, and just the right decision-making that's being put in place to really help fix the Burger King brand and the oversight that's brought, from the new CEO. And in terms of why now, certainly want to do this ahead of the quarter when we're pretty confident about Burger King US same-store sales, as well as Tim Hortons Canada same-store sales. That's the biggest piece of the puzzle at 45% of the adjusted EBITDA is that Tim Hortons Canada that's been executing very well and has momentum. And we think the top line there for those two brands will offset some of the cost pressures the business is currently going through.
And you did note that you're not acknowledging the risk of some choppiness in this turnaround story. What's giving you some concerns?
Yeah, so Burger King is obviously the second largest quick service hamburger brand, or now third after Wendy's, but we think they'll regain their second. McDonald's is obviously the 800-pound gorilla in the space. And what gives us some concern is just that McDonald's is firing all cylinders, and we cover McDonald's and think that performance will sustain. We think that Burger King can carve out its own niche. Right now, they're more focused on moving away from the discounts. That's helping them really grow their ticket and really help enhance their profitability. But we're going to see some stuff starting later this year on the fun side. And so what that means is you're going to see some new menu innovation around Whopper varieties. We wouldn't be surprised to see upgraded fries, and frankly, just a new approach to brand management that's been neglected for the last 5+ years. We're also very excited about that Burger King will be introducing later this year. And so, look, there's a heavy lift going on right now as they take the underperforming stores and try to figure out what to do with them, between closing them, between repurposing them to better performing franchisees. So certainly a lot of lifting there that's going to result in some messiness around potential for store closures, potential for franchise bankruptcies that might result in bad debt expense if we think about worst case scenario. But we account for this in our above consensus 23 through 24 estimates and really point to the exciting things they're doing at Burger King US to drive same store sales, as well as confidence for sustained performance and momentum at Tim's Canada, as well as Burger King International, which is more of a store development story.
And as we look at some of the themes that you think are going to be dominating the Q2 earnings season for restaurants, for the restaurant industry, what are going to be the standouts for you?
Yeah, so the key lesson I'd say exiting 1Q earnings season, which only wrapped up a month ago, so it's like here we go again. But the key things I would say are that margins are in clear focus right now, and that historically it was all about sales. I will say the restaurant sales environment has held in very well. That the consumer's been pretty resilient here. That certainly the 8% pricing we're seeing in the industry, the highest in the last 40 years. That is something that you're certainly seeing some negative traffic, just given that there is some elasticity with that. But by and large, sales are holding in well. And we expect that to persist basically through the first quarter, especially with disclosure for sales that are off to a pretty good start, for January and for February. So margins are really in focus right now with just glacial improvement that we're seeing within food costs and within labor as well. And so what we're really focused on is just the improvement in margins, the ability for that to continue. And for stories that are able to focus that that are able to show that margin improvement and show top line driven beats, certainly I think you're going to see the stocks continue to be rewarded, as was the trend in the fourth quarter earnings season.
We'll certainly be keeping an eye on that heading into Q2. Andrew Charles there, thank you so much. Consumer Restaurants Managing Director at TD Cowen. Thank you so much. All right, coming up, Endeavor snaps up WWE. It aims to give it and the UFC their own public mega listing. Is it a game changer with clear synergies, though, or could it spell danger for two already established businesses? We'll discuss next. World Wrestling Entertainment and Endeavor Inc., a massive merger. The WWE and UFC will combine to form a new publicly listed company with a value of over $21 billion. Joining us now to discuss is Brandon Ross, Lightshed Partners Media and Technology Analyst. I mean, this is a massive one here, $21 billion here. I wanted to get your take on the valuations for both of these companies.
Sure. Well, I think the market is telling you it's worth a little bit less than 21 billion at the current moment. That was the headline number. But really, those numbers were kind of drawn out of thin air because the bankers in the deal were making an assumption on what multiple the market would value this combined entity at. And right now, the market's telling you it's a little lower than what they hadn't anticipated. That doesn't take anything away from the deal itself. That's where the stock's trading now.
And what do you think of this synergy between the two? Some people say, look, this is a fit that's perfect for these two brands.
Sure. I think that in today's current media world, scale is always something that's helpful. I think right now you have executives in Ari Emanuel and Nick Khan who are both expert at negotiating media rights deals. And ultimately, the value of this entity is going to come down to how much they can extract in media rights for WWE's headline programming, which is Raw and SmackDown, and which are currently up for renewal. And when UFC goes to renegotiate their pay-per-view deal in a couple of years, where those numbers come out.
So for advertisers watching this then, I mean, obviously a lot of people pulling back on ad spend. Is this something you think they'd actually be excited about?
Well, I think in terms of the value that accretes to these companies, sponsorship is a big opportunity, and the ability to package sponsorship that moves across both WWE and UFC is probably an opportunity, especially because they're live events, and advertisers know that only live events are truly reliable these days in terms of building an audience. I think it's going to be attractive to them. But really, it's the licensing deals for media distributors that are going to determine how successful this company is.
And as we look at the organization structure, Ari Emanuel, their Endeavor CEO, will be the combined company CEO, but then Vince McMahon as executive chairman. You mentioned obviously WWE's Nick Khan as well, alongside Dana White there over the UFC. Talk about that organizational structure and what that might mean for innovation and what happens next with this merger.
Sure. I mean, the hardest thing to ignore is that Vince is going to continue to have a role in what happens with this business. I think probably one of the main reasons he chose this partner is because he's been doing this for his entire life, almost 78 years, and couldn't imagine himself not being involved. So as long as they give on the creative side, Paul Levesque, Triple H, the ability to continue to be the ultimate driver of creativity, I think this will work out well, but Vince is going to have to let go of the reins just a little bit. And you saw Paul's work really pay off this weekend in a very successful WWE. As far as having Ari and Nick involved, again, you have two of the best agents in the media business that you've had, almost ever. And so that's going to be a powerful combination.
And what do you think is going to get investors a little bit more enthused at the moment? As you mentioned, those valuations, they're a lot higher than the street was expecting.
Yeah, I think in terms of WWE stock, I think the street was hoping for a situation where there was a crystallized value of WWE shares, and they didn't have to worry or think about what these big renewals that drive all their EBITDA were going to look like. Now, investors have to sit back, re-examine how much value they think these deals are going to drive, and not just their own, but also UFC's deals. And so, it's kind of a put up or shut up for WWE. They're still going to have to perform to drive value for their shareholders. It's not at this point an absolute slam dunk as it would have been on a cash takeout.
And just very quickly, any idea of what we might see in terms of layoffs with this merger?
The company already announced that there would be between $50 and $100 million in cost savings. As you know, there's no cost savings without a little collateral damage in terms of employees. So you should expect there to be some significant layoffs.
All right, we'll be keeping an eye on that. We do appreciate you joining us this morning. Lightshed Partners, Brandon Ross, thank you for your time. All right, coming up, we take a look at what to watch throughout the rest of the day on Yahoo Finance. Stick around. Lots more still to come today on Yahoo Finance. The oil market is in shock today after OPEC Plus producers made a surprise decision to cut output. We've got you covered on all things oil with Neil Dingman from Truist later on in the day. And Disney's annual shareholder meeting kicks off today. Our team will speak with Needham senior media and internet analyst Laura Martin to discuss some key takeaways from the event. Right, well, before we go, let's get you a final check of the markets heading into the noon hour. Still a mixed picture here, though. The Dow, the only one in the green here, up 0.6%. S&P and the Nasdaq still seeing some losses, although the S&P just slightly down, about 0.02%. I'm Rochelle Akufa. That'll do it for me. I'll be back with you at 11 a.m. Eastern. See you then.